from New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Coming off the back of 3 days of gains on the S&P 500 from New York City this morning. Good morning. What a week we had last week, and to see us finish in positive territory is quite something. Something I've been asking, many others have as well. An example of a complacent market or a resilient one. We'll build on that through this morning and through this week as well. Equity futures up by almost 0.1% on the S&P. Nasdaq going the other way, negative 0.33%. We're down about 46 there. Is this coming off the back of what's happening in the bond market? Let's talk about that. Treasuries, 2s, 10s and 30s, 148.37 on 10s, pushing 1% on 5s. The belly of the curve, we had some weight to it over the last month. That's where the rate hike dance is playing out. And we need to be asking just a very simple question. If we do get a tightening cycle at some point starting next year, how loose will that tightening cycle be? That's important. That's the bond market. This is important too. The FX market. Switch up the board and get to euro dollar. The German election in a paragraph, inconclusive. Euro dollar a break of 117, and as Kick Jukes of SocGen said, Tom, we need to go from monetary policy to fiscal, and in Germany for that to happen, you need a conclusive swing to the left. We did not get that, and because we did not get that, euro dollar, in Kit Duke's mind over at SocGen, the euro has the blues.
Yeah, John, I would suggest that the recent bond dynamics here is very, very different from Fed watching and central bank watching, and has much more to do with the sum of all the parts of this September and into October. Maria Tadeo on the watch in Berlin off of the political moment for the Republic of Germany. She joins us right now. Maria, what happens today in terms of forming coalitions?
Well, you know, Thomas, the result was very tight, and we're going to see both parties, the SPD and the CDU, moving very quickly to try to form a coalition. The both of them say they have a mandate, they claim to have one, and they want to keep that momentum going. But this is going to be a very long negotiation, perhaps going into next year. What I would say, however, there is this impression this morning that Germany feels and looks like a mess. This was a very messy election. Having said that, I find that with that, you have to almost take a step back and look at what is really happening here. You have two very centrist parties that are pro-European, that in reality have a very common agenda, and ultimately any transition was always going to be difficult, especially after 16 years of Angela Merkel. So overall, if you take a step back, you do see that the tail risk of that left-wing coalition is not going to manifest. And in reality, when you look at the details, both an SPD or a CDU coalition would not really lead to a lot of change in this country.
Maria, as John was just talking about, there's an assumption that the messiness, that the lack of some sort of consensus and coalition will lead to a stalling out in some of the fiscal spending plans that previously had been proposed. Do you think that that is true, or do you think that there's perhaps more impetus to push through some spending?
Well, when you look at the manifestos from the SPD, they argued very clearly that they want to modernize the country, and that will cost money, and there needs to be more investment. When you look at potentially the kingmakers, the Liberal Democrats, they always said, we're not too caught up with a black zero, but we want to see that money being used properly. The fact that we're heading into a three-way coalition probably means that we'll have to see compromise across the board, and we're not going to see major spending happening in Germany. This is a country that is still very much traditional in its thinking. The results yesterday actually prove that. Germany's still very centrist, it's sticking with what it knows, and it's gone for two very centrist parties that in reality have very similar politics on the big front. It's the domestic issues where they change. But when it comes to Europe, we're probably not going to see a lot of change from what we've seen now. No one is promising a big breakthrough in terms of deeper European integration or major spending here. It's very much more of the same.
Maria, thank you. As always, great work through yesterday and into this morning. Maria Tadeo there Out of Berlin with euro dollar just south of 117 earlier, 117.01, down about 0.1% and change. Just the end of that conversation, Tom. That's a basic question for investors outside of Germany looking in. Will we see more spending? Is there going to be a big change? And the answer after that result is probably not.
Well, John, it's true. And it's also, frankly, from the outside looking in of Washington as well. I mean, again, to get back to where the bond market is, a turmoil here maybe is away from central bank analysis and more towards a Berlin or Washington political moment. That doesn't even speak to the chaos in London over energy and shipping. Right now in the U.S. economy, Scott Brown, Raymond James chief economist as well. Scott, with all the political turmoil, have you adjusted your GDP view for this Q3, the next Q4, or dare I say even into 2022?
Not really. We've got two big issues with the budget. One is getting an actual budget, getting the authority to spend. It's easy enough to do a continuing resolution. Even if we get a shutdown of the government, it's been there, done that for the markets, I think. The bigger concern is the debt ceiling. That really has to be raised, and then you start to flirt with default if it doesn't get raised. And we've been there before. I think 2011 was a pretty scary time. We actually saw the U.S. debt being downgraded. So in terms of the actual outlook on the economy, there may be some short-term disruptions. The infrastructure spending, the hard infrastructure, it's going to be spread out over many, many years. So it may be a few tenths of a percent of GDP in the next couple of years. The social stuff, the child care issues, early childhood education, those are very important because those will actually increase the labor supply over the next decade. If those get enacted, and that would help the overall economy grow.
Well, speaking of labor supply, we saw FedEx a number of days ago talk about wages. Morgan Stanley with a markdown on their overweight on Amazon because of wages. Do you ascribe to actual wage inflation? And dare I say, can the real wage actually increase?
I think that's likely. I mean, right now you're seeing higher wage increases, but a lot of it is getting eaten up by inflation right now. Theoretically, if you do have a lot of wage pressures, you're going to get reallocations of labor to its highest and best use. So that'll add to productivity growth in the U.S. But that's a very transformative process. It's very difficult. Right now, we're seeing obviously huge differences between where the jobs are, maybe where the unemployed workers are, mismatches in skills, and so on. Those things will take care of themselves over time, but it's going to be a pretty rough transition, I think, over the intermediate term.
We're seeing those labor issues appear in the UK in a massive way, Scott. I want to build on the power issues as well elsewhere. Some reports out of Asia this morning that both Apple and Tesla suppliers have stopped production at some of their facilities in China due to a power crunch. Scott, how much work are you doing at the moment looking at the cost of power, Europe, Asia, the UK, here in the United States as well, and what that could do to demand, production, output in the coming quarter?
Well, it's not just production; it's consumption as well. I mean, we hear people complain about higher natural gas prices in the U.S. You look at Europe; they're paying substantially higher. Asia, the same thing. That may have some impact on production. I mean, energy obviously is a big factor in production costs. Normally these things are going to take care of themselves over time. You'll get increased production, but we're seeing a lot of supply constraints in near term, and these things are going to stay with us for a while. I mean, we're surprised they've lasted this long. We're surprised they've been as strong as they are. And it does look like, this is going to continue into the early part of next year. And it does add some concern for inflation. We would like to see efforts made to sort of reduce these kind of pressures going forward. I know the White House is working on those kind of issues.
What do those efforts look like, Scott?
Well, you want to encourage supply. You want to try to find out where the bottlenecks are, any ways you can ease that. But a lot of it, if there are manpower shortage. And remember, we were getting reports from manufacturing and construction before the pandemic that they were having difficulty finding skilled workers. These problems are actually going to be more intense because the pandemic is still going on, and it's going to be going on, I think, for a while until we get everybody vaccinated.
Scott, how concerned are you about some of these supply chain disruptions and, frankly, the energy crisis that's percolating elsewhere, actually slowing growth materially? I mean, we got, for example, Nomura downgrading their expectations for China as a result of the power crunch that seems to be escalating. How much is it disinflationary from that point of view?
Well, we've seen in the Fed Beige Book, I mean, that was a big issue where a lot of industries were reporting that they were foregoing increasing output because they just didn't have the capacity, whether it's workers or whatever. That's not going to put downward pressure on inflation. In fact, it's going to add to inflation pressure in the near term. So these logistical issues, the supply chain issues, again, I think that's really a key story, I think, over the next several months. But ultimately, they're likely to be resolved. Now, one of the big issues we have is during the pandemic, we've had this shift from consumer services to goods because people couldn't go out and spend money on services. And that demand for goods is extraordinarily high and it's long lasting. We thought as the services rebounded, the demand for goods would start to wane a bit. We have seen a drop in motor vehicle purchases, but that's a production issue because of the semiconductors. If you look at the retail sales and you put it on a graph and you look at the previous, the pre-pandemic trend, we're 12% above where we were on that previous trend. So, I think these are some long-lasting changes into what people buy. So if they're buying more goods, getting the supply chain and everything just adjusted to that is enough. And then you throw the pandemic on top of that. And, these are going to be some significant issues. We look for a new normal, but we're not quite sure what that new normal is going to be for the U.S. economy.
I keep asking that question as well, Scott. Thank you, sir. As always, Scott Brown, Raymond James, Chief Economist, on some of these issues that will persist. And Lisa, that full service sector recovery, delayed, not derailed. That's the consensus view of most people that come on this program.
I do go back to what Peter Scheer said a number of months ago. Basically, he was saying, if the jobs are not filled for long enough, how much do we see those jobs disappear? And I do wonder about that, John, as people try to get things automated and perhaps just close down completely as a result of not having enough workers.
Go on, Tom.
Scott Brown there is always good, but he was just absolutely brilliant there. John, the recovery here in certain subsets of the American economy to the level before the pandemic or exceeding the pandemic is critical. And for him to say we're 12% off trend on certain items really shows the rebound we've had with all the stimulus.
For goods and not for services yet, because we are so constrained. Yes. Some of these numbers are remarkable. Tom Keene, Lisa Abramowitz, Jonathan Ferro, this Monday morning, good morning. Getting your week started with equity futures doing not much on the S&P, doing something on the NASDAQ. NASDAQ 100 futures down about 1/3%, and yields on a 10-year approaching 150, 148.71. On radio, on TV, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. In Germany, it may be months before there's a clear picture of who will lead the next government. Olaf Scholz of the centre-left Social Democrats defeated Chancellor Merkel's Conservatives in an extremely close election. Both Scholz and Armin Laschet of the Christian Democratic-led bloc said they plan to head the next government. All the German parties are holding talks in Berlin today to discuss their next steps. China will take further steps to rein in internet companies. A top government cyberspace official told the World Internet Conference that curbing monopolistic behavior and the disorderly expansion of capital are top priorities. He cited the shared economy, online healthcare, and smart delivery as areas of concern. Economists are warning of slower growth in China because of electricity shortages. Nomura has cut its full-year forecast for GDP, whilst Morgan Stanley earned of lower fourth quarter output. The power shortage is forcing Chinese businesses to cut back on production. And COVID has cut more than 2 years off the life expectancy of American men. That's the biggest decline amongst 29 nations in a study of pandemic's effect on longevity. According to the University of Oxford, deaths amongst working age men contributed the most to declining lifespans in the US. The largest proxy advisory firm is urging Tesla shareholders to reject 2 board members who are standing for re-election. They are James Murdoch and Elon Musk's younger brother, Kimball Musk. Institutional Shareholder Services is urging their rejection because of what it calls concerns regarding excessive compensation to executive officers and non-executive directors. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
David, you just hit the nail right on the head.
from business's most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The companies that can move the fastest and be the most agile, no matter what change comes their way, no matter how fast it comes their way, these are the ones that are going to survive and thrive. China's a good example of that now. You see across the board some of the rules and regulations that are changing, or maybe the uncertainty that's coming out of the Chinese government. And they're trying to deal with some of the local challenges that they have, both in terms of how to manage the asymmetry between the haves and the have-nots locally. They're trying to deal with the issues of managing data and security and other aspects like that. The companies that can operate in China and around the world collectively in a bipolar way are going to be the ones that come out of this on top.
Are investors going to come out on top, though, or are companies looking to do business within China from the United States, are they going to come out on top at the moment, Bob?
Yeah, it's clear that the investors are in for what I think is going to be a bumpy ride. You see it today in terms of what's happening in the marketplace.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Oil prices are up since your Concho deal, but some are saying that that is too high of a price. Maybe you paid a little bit too much. How did you come to the right valuation?
That's what's great about our cost of supply framework inside our company, because it's agnostic to price. So to fit our framework, Alex, the all-in cost of supply needs to be below $50 a barrel WTI.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The critical thing to get this pandemic under control, particularly here in the U.S., but also globally, is to get unvaccinated people vaccinated. Boosters have a role, and again, we want to protect those vulnerable from severe disease, but this discussion of boosters is sort of taking away from the critical point for controlling the pandemic, which is unvaccinated people.
Andy Pekosh there of the Johns Hopkins Bloomberg School of Public Health. Also an Arsenal supporter going into the weekend. Tom, and coming out of the weekend, I'm sure, very happy. From New York City this morning, good morning, alongside Tom Keane, Spurs supporter, Lisa Bravitz, Jonathan Ferro. Equity futures unchanged on the S&P. In your bond market, approaching 150 on 10s, yields higher by 4 basis points to 148.71. You could go to the euro, it's negative, or you could go to the commodity market, pushing 75 on WTI, 74.84. It's 5 weeks of gains. Add some, Tom, up by 1.16%.
My trick there, John, is when you go up, I look at Brent moving higher than WTI, and Brent with a near 80 handle. Remember, John, when Curry, Morse, and the others were saying $80, and we said,
yeah, well, really? Almost there now, Tom. And Francisco Blanche, what was he talking about? Triple-digit crude by next summer.
Yeah.
And if we get a cold winter, he'll bring that in 6 months. So here we are at 75.
The rate of change is there. On the pandemic, with the death count well above 2,000 in the United States, still a scandal. Joshua Sharfstein joins from Johns Hopkins. Professor Sharfstein, in our comments before going on air, you mentioned that the mask debate is really what matters right now. The CDC out with a report of relatively successful school openings. I think a big 96% there. But on the debate over masks, where stands we?
Well, there's more and more data that kids wearing masks in schools reduces the spread of disease, which is not surprising insofar as there's so much evidence at this point that masks prevent the transmission of COVID. So the CDC studied within Arizona, I believe, the the districts that had mask mandates with the ones that didn't, and there were a lot more outbreaks where there were no mask mandates.
3.5 times, yeah.
Yeah, and so you know, I think that there are ways to safely open schools to reduce the risk of outbreaks, and it just makes sense to take them. Now, they don't necessarily have to be continued forever. But right now, where there's still a fair amount of transmission in the community, it's just, I think, appropriate to protect kids as you are, moving forward with school.
What does the end of September and October look like for the 5 to 11 cohort?
Well, the company, Pfizer, is certainly saying that it has the data to support an emergency use authorization for kids 5 to 11. They'll be presenting that data to the FDA. The FDA will reanalyze it and give us the agency's view on whether it's strong enough. And if that all works out, I think it's quite possible that in October we'll see an emergency use authorization for younger kids. At that time, only a few thousand younger kids will have had the vaccine. So I think this is not, a discussion for immediate mandates. I think it'll be parents who are really eager to get the vaccine will get it, and there'll be more and more experience that will guide the country.
Dr. Sharfstein, I know a lot of people are very hopeful that October is realistic. Meanwhile, Oxford University put out a study this morning that showed that American men lost 2.2 years of life as a result of COVID. I'm wondering, is that due to comorbidities, or is that due to a healthcare response that was insufficient?
I would say it's probably neither of those two. I think we had such a severe COVID problem in this country because we were unable to really prevent cases. Our healthcare response, everybody did everything they possibly could. But when there's so many cases of a disease that can be fatal, people are going to die. The key would have been to prevent cases, to be more effective with testing and contact tracing and vaccination. And if we can't do that, we're going to have a lot of deaths, no matter how many hospitals we have or ICUs we have. And, within that 2.2 years is just a tremendous racial disparity, which also we have to understand better, because our systems, including public health systems, failed to prevent just a profound problem with equity.
How much is this in the rearview mirror at this point, or how much are we seeing the same crisis unfold in pockets in the United States where the healthcare system is starting to get incredibly strained as a result of the load of cases?
Well, it's really just horrible what's happening in different parts of the country, and you can, obviously follow what's going on in Idaho with the extra morgues that they need and the crisis standards of care. I do think it will get better. The modelers at Johns Hopkins are saying, these states are just getting swept through with the Delta variant because they have low vaccination rates, but that will pass like it passed in India. And we probably will be in a much better position in a few months, a much better position, assuming we don't have more variants come. So I do think that we are not stuck where we are forever. But the more people who get vaccinated, the faster and more durably we'll be in a better place.
Well, how does a viral pandemic stop? How'd they end in Venice in the 15th century, or America in the 21st century? I can't even remember anymore.
Well, there's a theory. Yeah, there's a theory that one of the pandemics in the 19th century was actually caused by a coronavirus that is now just one of our common cold viruses. And, basically humans and the virus kind of learned to live together. That happened maybe over a fairly long period of time. I think for us, we're going to, build up immunity through vaccines, build up immunity from having been infected, and we're just going to see that COVID becomes less and less of an urgent concern at the population level. We've got there in the United States the hard way, frankly, with so many people dying.
Joshua, just before you go, just a final question from me. I think there's a lot of people watching, listening to this program this morning that still don't know whether they are eligible for a booster shot. Can you walk me through who is and who is not eligible for a booster shot in the United States of America?
Sure. It is people over 65, people who are 50 and over with conditions that predispose them to severe COVID, and people who have potential occupational risk. And people can talk to their doctors if they have any question about it. The booster shots, I think, are likely to reduce the chance of a mild to moderate infection. But the good news is people who've gotten fully vaccinated are maintaining a very high degree of protection against hospitalization and death. So I think, you can walk to get your booster shot even if you ran to get the first shot. That first shot and the second shot are incredibly important at protecting against severe illness and death.
Joshua, thank you. Thank you for that clarification. Joshua Sharfstein there of the Johns Hopkins Bloomberg School of Public Health. Tom, I have to say, a ton of confusion around that last week. And notice how Joshua said the fully vaccinated. I just wonder how that definition shifts over time, whether fully vaccinated starts to include a booster shot, Tom, going into New Year. That one's open for debate, but the conversation's already starting.
The booster shot thing is from our childhood. And, they used to hurt more. That's what I used to remember. I'm going to have to go. Yeah, Lisa's going to go with me and hold my hand in the middle of October.
Lisa, what it's like to have seen so many centuries that you forget which century.
I love that. 20th, 21st, Doctor, where are we?
I forget.
I'm a bit addled.
The 1800s
Is Harry
or something.
Kane with the tots or not?
Did you still get the
Technically he
lollipop?
is, Tom, from New York.
1980.
Good morning to you all. Equities Unchanged. This is Bloomberg.
There is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia like Taiwan, where they're having trouble meeting the demand. The supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
Who are U.S. Open tennis champion Emma Raducanu's three dream dinner guests?
Daniel Ricciardo, Michael Jordan, and then Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
great exit, if you will, from these emergency policy settings has begun.
The ECB is curbing their PEP purchases. You know, the BOE wants to raise rates. The Fed's moving towards exit.
The 10-year Treasury is probably right about where it should be based on where we're headed.
The Fed's already positioned itself behind the curve vis-a-vis the last cycle.
The Fed has said it's going to let inflation run, but against that, I would say inflation is running at a pretty furious clip.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The bond market making some noise from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market down 1/10 on the S&P, negative 0.5% on the NASDAQ. Your bond market yields breaking out, approaching 150 TK on 10s.
Markets are big. We've got a really important guest coming up, which says don't panic. But John, I'm going to go away from red and green on the screen in the equity markets and say all sorts of levels moving rapidly up to technical breaches on this Monday. It's very exciting.
Question of the morning, Tom. How loose will any tightening be at the Fed and elsewhere?
Yeah, I'm going to go with the central bank analysis here, John, but I think it's a little bit Washington, a little bit Germany. Maybe it's just global economics. Look at commodities. And again, I go back to oil, right up near a Brent print of $80 a barrel. It's a game change Monday is what I see.
74.82 on WTI, pushing 75, a break of that a little bit earlier. Lisa, down in D.C., the policy effort, Speaker Pelosi teeing things up for later this week.
It's such a mush right now in terms
perfect.
of everything.
Love
I mean,
it.
honestly, I'm just looking right now. You've got central banks that are moving away from their pandemic-era policies, but they're not necessarily tightening policy anytime soon. They're just removing some accommodation. You've got Washington, D.C., which is just a soup. And frankly, some of these moves are incoherent. If the Fed were going to let the economy run hot, John, with a shallow policy response, why isn't the yield curve steepening more?
How much steeper do you want it, Lisa?
Well,
We've had a move from 112.58 on 10s out to 150.
Okay, you're talking about the 210s.
Sure. Where on the curve are you looking? 530s?
If you do 530s, if you do 510s,
Take your pick.
you take your pick. I mean, there isn't necessarily a significant steepening akin to the Fed's going to be really, loose with their policies with really high inflation.
On radio and TV, we bring the show to a complete halt. I was getting my morning tang, John, and I actually looked at Tuesday 10 across like 3 technical studies. We have moved rapidly right up to a trend breakout on resistance. We're not there yet.
Lisa's
but
not
I'm
satisfied.
sorry, a 120 on Tuesday 10. Jamie Dimon's waking up this morning going, yeah.
It depends where you pick on a curve, doesn't it? That's the story here. And I think the belly of the curve is where this rate hike debate is playing out right now. 5's approaching 1%, Lisa. There's a real lift there.
And this, I think, is really the question. Can the Fed afford to remain as loose as they've promised? Is that the implication in some of the medium-term bonds, that basically the Fed's hand is going to be called, so they're going to revert back to tightening?
2's back to 120, a little bit steeper. As I say, you can take your pick to explain whatever story you want to explain this morning. It's your equity market, Tom. We've got work to do. Equity futures come in too. We're negative almost 1/10 of 1%. NASDAQ futures down 70. We're down almost 1/2 of 1%. Yields are higher by 3 or 4 basis points on 10s to about 149. TK, very focused on the oil market this morning. Lisa, through 75. We're at 74.82 right now on the screen.
I'm going to keep asking this question for the next week and probably the next month. Are higher oil prices inflationary or disinflationary in the longer and medium term? 9 a.m. and 12 p.m. we're going to hear from New York Fed President John Williams, just one of the many Fed members who are going to be speaking throughout the week, throughout the day. I want to hear specifically what he has to say on this point, the idea of supply chain disruptions, higher oil prices. How much is this an inflationary input, and how much does this slow growth in a way that they're concerned about? 1 p.m., the U.S. Treasury is planning to sell $61 billion of 5-year notes. This is interesting in light of the near 1% yield on 5 years, on 5-year bonds. You can see the yield climbing up to some of the highest levels that we've seen going back to February of 2020. And today, talking about the legislative agenda, John, House Speaker Nancy Pelosi said she's going to be bringing the $550 billion infrastructure bill to the floor. This is interesting because a lot of of progressives will not even look at this before there's an agreement on the $3.5 trillion plan that's now perhaps $2 trillion, perhaps $2.5 trillion, perhaps $1.5 trillion. Is it going to get done? We don't know.
Lisa, thank you. Lisa Brambett's there on the week ahead, potentially what the week might look like. We've got to start with a fantastic guest this morning, Jean Bavin, head of the BlackRock Investment Institute. Jean, you've got this framework, the new nominal. I'll allow you to explain that in just a moment. The conversation we're having, once we start raising interest rates in America, maybe the back end of next year, who knows, Jean? I can't predict next year. How steep will that policy path be? How shallow will it be? How loose will any potential tightening be? The answer to that, Jean?
I think it's going to be the shallowest we've seen in decades. We have to go back to maybe the 50s or 60s to see the same kind of shallow patterns I think we're going to see. So nothing of the recent cycle I think is a guide, much shallower. And I think we've seen much more ongoing evidence that they are on the slow path. I think they've been very deliberate to try to separate the taper discussion last week from the liftoff and from what it's worth. We cannot predict 2022, but I think it's a 2023 story, the first rate hike.
Jean Bavin, BlackRock and your team unabashedly say you're pro-risk. I mean, you mince no words about it. How do these changes, the worry out there, affect corporate thinking with a higher yield regime, with a steepening of the curve, and on and on? How does pro-risk come over to corporate action?
Yeah, so the path ahead for equities or risk assets to break higher is getting narrower. So I mean, I just want to acknowledge that. And after a streak, I mean, you look at the chart of the S&P. You start in January 2020, and you look at it, and there's no way you can tell there's been a pandemic. So I mean, this does raise question. I think we're going to be in an environment where markets will be more primed to look at risk and maybe more volatility. But in that environment, we still think that the fundamentals are constructive for the time being, and as a result, we will look through that. That's where the pro-risk on the bashing version is coming from.
How concerned are you about what's going on in China with respect to not only the scrutiny of the tech companies, but also what some people are calling an increasing energy crisis, especially as the regulators try to clamp down on fossil fuel usage ahead of the Olympics?
Yeah, so I think, broader story in China is that, the direction of travel towards a greater role of social objective politics over economics is unmistakable. It's playing out, and I think we should all acknowledge that. It changes the lens of investment. However, we've seen a very steep decline in activity throughout the course of 2021. I mean, from 18% earlier this year to Q4 that's going to look sub 4 as far as we're concerned. So that's a pretty steep decline. And even a country that is, on a path to put other objectives in front, I think they cannot ignore this weakening growth. So that makes us, we've been neutral on Chinese equities for the last few months. But we start to think now that it's time to dip our toe back or start to dip our toe in the Chinese equities, given that, we see some easing of the various policy tools over the next few months.
Wait, Jean, can you elaborate on dipping your toe back into Chinese equities? Where do you see as sort of a safe place to park amid still a lot of ongoing uncertainty?
I should clarify the back, because we've just broken out Chinese equities as a standalone asset class for the first time in June, our mid-year outlook. So, I mean, there's no back aspect. So, but we're dipping our toes in the sense that, you've seen a 25% underperformance of the Chinese equities over U.S. equities for good reasons. That's why we were neutral. But at the same time, that's a pretty, the gap has been pretty material in terms of the two regions. And while there's a lot of uncertainty, I mean, that means the risk premium has increased quite considerably. And now I think it's the time to think about opportunities reappearing. I'm thinking about broad market exposure here as opposed to specific. And but that broad market exposure, that broad market story, I think has repriced quite a bit.
Jean, just quickly, final question. How do you reconcile your bond market call, your Federal Reserve call, with where you want to own in the equity market domestically here in America?
So we think the bond market call, just to clarify, is we think rates on the way up on the 10-year. We've been increasing our underweight of U.S. Treasuries over the course of the last few months. Our conviction has not waned, despite the fact that it had been stubbornly low over the course of the last few months. But we think the direction is up. That said, it's in the context to go back where we started, where we're going to see a very shallow normalization of policy rate in the U.S. And as a result, and some more inflation coming. But this combination of inflation coming through with very low rate, it's a real rate environment that's very negative and continues to be, and that will be supportive of equity or risk asset, even in the U.S. We're neutral on U.S. equity, though, just to be clear, and I think that's more coming from at this juncture, the fiscal policy landscape on the tax front, debt ceiling, and we're gonna hear more this week.
Wait, hold on a second, Jean, just right there. I want to make that clear. You care about the debt ceiling.
We think there's headline risk around the debt ceiling. Ultimately, we put out a note last week where we say, there's going to be noise. The market is prone to be reacting to noise in this juncture, like we said, but we will advise looking through. But the headline risk is there. But again, we have uncertainty around how big these package will be as a result. We have uncertainty around corporate taxes and the like, and that's the neutral stance on U.S. equity.
Jean, thank you. Jean Bavin, there of BlackRock, the Investment Institute head. So I'm just trying to reconcile the thoughts there from the bond market, the Federal Reserve, over to the equity market, and where in the equity market you want to sit.
Well, we strive for clarity of notes, and I'm sorry, BlackRock and Mr. Bovin, they have a real clarity to be pro-risk. They really push against the accumulated gloom right now.
What do you make of that story, though, Tom? The higher tolerance for inflation and the lower rate path that they're anticipating?
I think it's a level where we are historically, and we are so far below any form of restrictive we are miles, John, from neutral or restrictive, because John Williams will address that today.
Without a doubt. Looking forward to hearing from the New York Fed president. We'll hear from the chairman of the Federal Reserve tomorrow, alongside Secretary Yellen, testifying down on Capitol Hill. We'll hear from Gene Tanuzza of Columbia Threadneedle in the next hour at 8 a.m. Eastern time on this bond market, with yields approaching 150, 148.54, yields higher by 3 or 4 basis points, and the equity market down 6. We're negative a little more than 0.1%. Heard on radio, seen on TV, Tom Keene, Lisa Bramett and Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In Germany, Olaf Scholz of the centre-left Social Democrat says he hopes to form a government by Christmas. The party won a narrow victory in yesterday's election. Scholz is calling on the Greens and the pro-business Free Democrats to join him in a government as soon as possible. Meanwhile, Armin Laschet of Chancellor Angela Merkel's Conservative bloc insists he will also seek a deal with the Greens and the Free Democrats. The head of the CDC warns that parts of the U.S. health system are in dire straits because of the spread of the COVID Delta variant. Rochelle Walensky told CBS it is forcing some states to prepare for rationed medical care. Idaho and Alaska have said that hospitals can begin to prioritize who is treated. Google's YouTube says the company still sees free speech as a core value. Despite a controversial move in Russia, Google and Apple both pulled a voting app from opposition leader Alexei Navalny before Russia's general election. YouTube also removed some Navalny videos after Russian government requests. CEO Susan Wojcicki spoke to Bloomberg.
We certainly get requests from governments, and we look and consider why are we getting the request, what's actually happening on the ground, and based on a whole bunch of different factors, we make a decision. So we don't always, those are not always requests that make sense for us to honor, but in certain cases, we will honor them in that country.
Wojcicki declined to comment on specific requests from Russian officials. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you went to Harvard Law School, did you say, maybe someday I'll be on the Supreme Court?
Anybody who thinks maybe someday I'll be on the Supreme Court, I don't want to say there's something wrong with him, but there is something wrong.
Angela Merkel, after 16 years in power actually, remains one of the most popular, if not the most popular German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We have seen large numbers of individuals encountered at our border making a claim for asylum, for humanitarian relief, which is a statute, which is a law. This is nothing new. It spans many, many years. It spans different administrations of both parties, and it speaks to the need for legislative reform.
That was Alejandro Mayorkas on Fox News, the Homeland Security Secretary from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bramwitz, I'm Jonathan Ferro, heard on radio, seen on TV. This is Bloomberg, and here is your equity market price action. We're -3 on the S&P. We're down by 0.06%. Not much happening there. There's something happening in the bond market, though. Yields up by 3 or 4 basis points on 10s to 148.54. Can you line that up with what's happening in the NASDAQ? NASDAQ 100 futures down 76.
I think you can.
We're
Good
down
point.
0.5%,
Yes.
Tom. And let's just get to euro-dollar, too. Euro-dollar, earlier on a break at 117. If you're waking up stateside and wondering what happened in Europe over the weekend, it's a really, really mild move in euro-dollar, down about 0.1%. We had an inconclusive election result in Germany. The SPD and Olaf Scholz, with a very narrow lead, Tom, they're going to spend a long time now trying to put a coalition together. For investors, you were looking for something transformational, some big spending, a big win on the left. That's not what we got, Tom. It's as you were in Germany for the time being.
Yeah, the coalition, and this goes to where we're going with Emily Wilkins, but the coalition here, folks, is on the development of the left with the SPD of Mr. Scholz, and that is a mystery, to say the least. We're going to do something we do different usually. Usually we do a different theme in Washington, hour to hour on Bloomberg Surveillance. On radio and television, we break that rule this morning because it is so important to look at our congressional political experiment. Emily Wilkins drives forward the conversation from Anne-Marie Horton earlier this morning. Emily, I want to look at the whipping of votes. Who's doing the whipping of liberals in Congress?
That is actually a really great question, Tom, because it seems at this point that there isn't really a giant whip operation underway. We do know that President Biden was making calls from Camp David over the weekend, speaking to lawmakers. Obviously, lawmakers have been speaking to each other, but at this point, it's not really clear exactly how many progressives will or will not vote for an infrastructure bill if they don't also bring that reconciliation bill to the floor, something that is really not possible before the planned vote this Thursday. So there's a huge question mark around that as well. Another factor, how many Republicans might wind up voting for that infrastructure bill. Last week, I had Congressman Brian Fitzpatrick, head of the Bipartisan Problem Solvers Caucus, one of the big backers of this bill, say that he expected at least 10 to 11 Republicans to vote for it, potentially with 5 or 6 more. But that's still a very narrow margin for Speaker Nancy Pelosi.
To borrow from the politics of the great movie Casablanca, Emily, I recommend you see it if you have a chance. And the idea of Casablanca is to round up the usual suspects. They've got to go out and round up the usual liberals. What's the character of the negotiation? Is centrist or leadership speaks to the modern liberal?
See, but you got to remember, in Casablanca, they rounded up all the usual suspects, and they still didn't get the one person who wound up doing it. I mean, this is a really difficult
film expert, Emily Wilkins.
It's a difficult balance here because you not only really have to manage the progressives, but you also do have to manage to some extent the moderates. Their big question is whether they're going to try to bring the reconciliation package that we saw advance in the Budget Committee over the weekend to the floor to try to appease the progressives. But in that case, you're going to lose some moderates because they're going to say, hey, this bill, it's $3.5 trillion. We know that's too big to go through the Senate. Speaker Pelosi admitted it herself. And there's still a number of debates within that reconciliation bill. I know Anne Marie pointed out a few earlier that really have yet to be resolved. And so it's trying to balance these two different groups and try and figure out some sort of solution. I think to a big extent, it's going to be trying to convince progressives that, look, even if they vote on infrastructure without reconciliation, that reconciliation is indeed coming. That's the biggest fear for progressives is they pass infrastructure now and then moderates and centrists say, well, we think we've done enough, and they never wind up passing those climate change provisions, Medicare provisions, and healthcare provisions in general.
Emily, it seems to me, and please correct me if I'm wrong, that Nancy Pelosi expedited the timeline for this pretty significantly by setting a Thursday vote. Why did she do so?
Because moderates demanded that there be, or that consideration of this begin on the 27th. So that was one thing. Pelosi knew that she was going to be in trouble, in danger of losing votes if she didn't do it now. The other component is that this infrastructure bill includes funding for highways that needs to pass, and that will run out on September 30th. So that's a very hard deadline right there. And this is usually a bill, it passes pretty annually. It's something that there's usually a lot of bipartisan support on. It's not very controversial. And progressives know that if they wind up holding back this funding as this deadline approaches, that could potentially cause issues for them in their districts and among their constituents.
Emily, thank you. Emily Wilkins of Bloomberg Government down in Washington, D.C. Over in Germany, in the capital, the CDU, the CSU, giving a post-election briefing. The CSU saying Conservatives have no mandate to form a government. Largely believe, Tom, that the SPD is first in line to form a mandate with Olaf Scholz with that narrow win in yesterday's election, and that's still the case this morning.
Help me here, John, but SPD, Willy Brandt from years ago, they're comfortable with the left. Who is the CSU comfortable with?
Well, it's not about the CSU this morning. This morning is about the FDP and the Greens. And what we're learning this morning from the FDP is they've decided to start pre-talks with the Green Party. So this is what it's going to come down to, Tom.
Wow, I'm lost.
To what degree can the FDP work with the Greens? What can they agree on? What do they disagree on? They're going to be the kingmaker for the SPD. Did that make sense?
Right.
Or are we all confused about German
politics? No, I'm totally confused, frankly, like it was yesterday. It was sport. John, can we admit that yesterday and this weekend was magical for global sports? What I loved was Southampton, Wolverhampton, and the angle of the sun, and just the beauty of it. Seriously, it was really...
I just love that you've skipped from German politics straight to
Well, I went to Southampton because we're on top of the Chancellor of the Exchequer's team, but
they lost to Wolves.
They lost to the Wolves and all that, but you know, and then in baseball, in American football, and the rest of it. And John, this tops it all. This gentleman is 87 years old. John, I don't know if you know Bob Uecker. This guy was a mediocre pro ball player, and he has become beloved, starting with the iconic ad of the 70s for Miller Lite. I must be in the front row. John, go watch it. You'll love it. Uecker, iconic with the Milwaukee Brewers. So he goes out, John, to throw out the first pitch, and he uses a pitching machine. That's classic Bob Uecker.
Tom, let's be clear. That's what I would do as well.
Yeah.
I saw one of the first pitches recently. It was from an MMA fighter, and it was absolutely Shocking, Tom.
Yeah.
Shocking. So to avoid that, I probably would use that machine too.
Classic, Bob. John, you and I got to sit down once and watch a Miller Lite commercial so I can explain to you how this guy completely took America in the 70s with a 30-second spot.
But we still haven't watched the baseball game together, TK.
Well,
Missed
we
a nice
can't
window
because
over
the
the
Red
weekend.
Sox keep losing.
What happened with the Red Sox?
Look, baseball's great. The Padres are out. The Red Sox are out. It's been a magnificent season. John, the most important thing I saw this weekend, another record length of baseball games. I love the way Premier League does it.
Just gets it done.
Gets it done. Baseball's got to do the same thing.
It goes on forever.
It goes on forever.
How many
You're
games?
right.
How many games a season? Like 200?
No, it's 162, but I've
Come
watched
on.
maybe one full game all season.
From New York City this morning, good morning. This is Bloomberg.
China, if you look at U.S. taxes, how much time do you spend figuring out these big overarching themes as opposed to what happens with inflation?
There's an awful lot going on at the moment, as you say, and clearly some of the big debates at the moment are the slowing global growth picture, which we're seeing everywhere. And we're also seeing that at a time when inflation is rising and is proving pretty sticky. And to your earlier points, Francine, essentially the interplay between those two is critical. So some of those news events this week, whether it's OPEC and what's happening from a supply perspective, is going to be crucial, or indeed, of course, that US CPI print. So we've spent a lot of time thinking about inflation more recently, because clearly that leads into when we feel you may start to see the taper and when you might start to see rates going back up, particularly in the US. I mean, what might be useful just to explain a little bit is the focus that we've seen from everybody on China. You know, clearly China, huge in terms of the global commodity cycle.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Live from New York City on radio and TV, this is Bloomberg Surveillance. Let's get to work. We're down 5 on the S&P. We're negative a little more than 1/10% on the NASDAQ. Down 0.6% off the back of 3 really tidy, nice, decent days of gains on the S&P 500. We pulled back just a little bit. My attention, Tom's attention, Lisa's attention, very much in the bond market. It's about where we were and where we are. Switch on the board and get to 2s, 5s and 10s. 2s were just below rather, 15 basis points on 2s back in June. Right now, we're back to 28 basis points. Yields higher by a basis point today. 5s were in the low 60s in early August. They're pushing 1%. 10s were at 112.58 in early August. 10s now are really retracing that move, Tom, getting back towards about 150. But it's the move on 5s that gets your attention. 2s out to 5s through the belly of the curve. We're starting to price in a bit of a hiking cycle here, Tom. We're starting to have the conversation about how loose any potential tightening will actually be. Jean Bavin of BlackRock pushing back against this idea that that rate path will be steep. Yep. Others, Tom, are going with it, and that's the debate for this bond market this morning.
That's a partition there right now. I like how you put that with Dr. Bavin of BlackRock with his esteemed economics. But, John, it really is two-part, and it's the curtness of the bulls saying, calm down, versus everybody else looking at new walls of worry.
We threw in the 30 there. For you as well, through 2%.
Yeah,
just for you, Tom. Through 2 basis points higher on 30s, through 2%. Let's finish on this, TK. Crude, 5 weeks of gains on WTI.
It's a crude analysis.
A breach of 75.11, you could call it that. We're positive by 1.5%. And Tom, I've just got to go back to the call from Bank of America and Francisco Blanche, looking for triple-digit crude potentially the middle of next year, and wondering whether we get it this year, Tom, through winter, if we get a cold winter. And the power story right now...
here we go, blaming the weather.
...in Europe is phenomenal. In China, it's really fascinating.
John, are you going to go be a truck driver in the United Kingdom? Can you do better there?
You can train for your HGV license. Tom, it takes a while. I understand there's a backlog, but they're thinking of bringing the army in to help quick that process up a little bit. So maybe you can come with me. Maybe we can do that together. We can go train to be a heavy goods vehicle driver, Tom.
I got 8 ways to go here, but we don't have the time right now.
Driver's license first.
They've loosened up the visa requirements, Tom. That's the good news. Yeah. So you and I can go back together and become truck drivers. That'd be something. Here's your cross-asset price action, then cruise 75.11. Let's get you some movers this morning. We can do that with Romain Bostic. Good morning, Romain.
Hey, good morning, John. I want to pick up where you left off there. Of course, energy is the story today. Marathon, Occidental, pretty much everything in the oil space here in the U.S. higher here in the pre-market. Of course, a lot of that has to do with the energy crunch, of course, going on around the globe. Really here, you talked about WTI breaking above $75 a barrel. At one point, it looked like Brent crude was actually ready to flirt with $80 a barrel here. 5 straight weeks of gains on WTI, 3 straight weeks on Brent, and you're looking at the XOP at the bottom of your screen. That's up about 1.8%. That ETF right now setting up for its 5th straight day of gains here. Of course, we talk about some of the data out of last week. You saw a 21 million barrel drop here in global supplies, global inventory here. That's a huge deal. You add to the fact that natural gas prices are surging. A lot of people are having to switch over to oil here to keep those factories up and running. And a lot of analysts, a lot of strategists say that the push higher here in oil could continue. Flip up the board. I want to stay on the energy theme because one thing that's really flown underneath the radar here is that global energy crunch, specifically there in China. There's a huge power crunch going on over there. And we had a report out of Nikkei over the weekend here saying that China had actually mandated the shutdown of several production facilities in order to meet certain consumption targets, basically to keep below those consumption targets. You're seeing Apple, Tesla, Intel, Qualcomm, all huge manufacturers here that have big operations in China basically being affected by it. All of those shares slightly lower here in the pre-market. We're still waiting on confirmation from those U.S. companies as to how this is going to affect production. But remember, for a lot of these companies, it's not only about the primary production, but you talk about Qualcomm has a huge chip testing facility over there. Intel has a huge packaging facility over there. So even if the primary production is able to keep up and running, some of that end production could certainly be affected by this. Something to keep an eye on as we move through this trading day. Tom?
Romain Bostic, thank you so much. Look for the close, and a really interesting the close as we move into the earnings season. That brings us to Gina Martin-Adams right now on these equity markets. And what we've seen, Gina, is real simple here. And you at Bloomberg Intelligence, you're massaging this all the time. FedEx, forget about revenue. It's down the income statement. Amazon with the Morgan Stanley markdown, still overweight. Not revenue dynamics, it's down the income statement. Are we forgetting revenue as part of the story?
I don't think we're necessarily forgetting revenue as part of the story because the stock market is still rising along with revenue growth. What I think is happening is we are starting to see certain stocks within the stock market getting picked away at as a result of margin pressures, eroding some of that revenue growth when it comes to the bottom line. So we've got roughly a third of S&P 500 companies that are experiencing some degree of margin pressure, whether it be earnings related, commodity price related, cost of goods related in any manner. Those companies have gone through something of a margin squeeze, and they're experiencing a very different reality than the rest of the index, where revenue growth is still rising, margins are no longer under pressure, and the stock prices can rise.
This is critical in that it's, I'd say it's two-part barbell market. You've got stocks that are perceived as having revenue growth, and critically, there's a wall of stocks, hundreds of stocks, where the revenue growth just isn't good enough.
Yeah.
What do those companies do?
Yeah, well, unfortunately, they have to manage their costs. And what we've experienced in this recession is completely anomalous relative to past recessions. It's almost impossible to manage costs when the labor market has recovered as fast as it has. We've also got a point in time where we might start to see tax increases to add to cost pressures, effectively reducing overall margins as well. So companies, unfortunately, are forced to manage costs effectively. They've got to lean on technology. They've got to manage costs. They've got to find ways to create greater and greater market share gains. To your point, maybe they merge.
Maybe they merge.
Find ways to find greater market share gains to make up for that added cost pressure.
John, it's like Tottenham. They need synergy.
They need synergy.
Yeah.
They're looking for a merger in North London, Tom.
Well, yeah, they could.
I don't think there'd be a merger of equals right now with Arsenal. Here's the quote from Morgan Stanley. The spread between GDP growth and wage growth correlates fairly closely with operating margins over time. Based on our economics forecast, this spread should decelerate in coming quarters, which suggests margins should contract, not expand. Going into earnings season, Gina, let's put some numbers on this. What are you looking for? You actually looking for contraction then, margin contraction through this earnings season that starts in about 2 weeks' time?
I don't think we'll see margin contraction, but I do think we'll see margins that are at a lower level than they were a quarter ago. We already saw this in the second quarter. We started to see companies record margins still high relative to long-term perspective, but not as high as they were in the first quarter. I think that pressure is going to continue into the third quarter. What we're seeing across the index at large is roughly now half of companies are experiencing downward estimate revision as a result of margin pressures emerging. All of it operating margin. Net income margin is still well intact because companies are still paying extremely low levels of tax and very, very low levels of interest expense. But that too will likely change into 2022. For now, you're looking at a 50-50 split. Some companies experiencing too much pressure on the margin lines to satisfy analyst expectations. Other companies generally able to pass costs on. So it's very much mixed results.
Let's say we get Francisco Blanch of Bank of America's projection, and we get $100 a barrel for oil by the winter time. What is that? What does that do to the S&P at this point?
Yeah. It absolutely damages some of the cyclical call. Certainly industrials and materials, in particular those companies like the FedExes of the world or the other companies that have high exposure to that energy cost will likely experience even greater margin compression going forward. And then the consumer space. I mean, if you think about the consumer at large, consumer spending on energy relative to income is extremely low. But for some of the lower income households, higher energy expense is going to feed through to higher transportation costs, which certainly results in pressure on retailers, some of the consumer staples companies, even some of the discretionary space where energy costs are a competitive cost with other discretionary spending.
So Gina, just to put a bow on this, are you saying that higher oil prices at this point threaten the cyclical trade that a lot of people have leaned back into?
They do, parts of it. Certainly higher oil prices are great for the energy space, energy being a portion of that cyclical trade. Higher oil prices might also be okay for financials, where we continue to see some budding debt growth. And so I think it creates this divergence within the cyclical space as opposed to damaging the entire thing. You've got damage on some of the consumer, the materials, and the industrial companies, while it could benefit, actually, energy and financials.
Gina, thank you. Just a summary to set us up, Tom, for earnings season that starts in a couple of weeks. Gina Martin-Adams there of Bloomberg Intelligence. This conversation on margins and cost pressure, labor costs, power costs, transit costs. Tom, take your pick. Costs are up.
We've seen it. Yeah, costs are up. We've seen it before, John, and revenues come to the rescue. But what I would go to the analysis, John, of a two-part market, and do you want to pay a premium for identified revenue gainers? That's the chess match that's out there right now.
That's the game going into earnings season, Lisa. Where in this market do you want to sit?
And that's also the game with respect to inflation, with the input prices. Is this a short-term burst that's going to lead to disinflation or a slowing of growth in the long term, or something that could threaten the hand of the Fed over the longer term with a tightening cycle, as you've been talking about, that a lot of people expect to be pretty loose?
The power issues I find to be absolutely amazing. The reports coming out of Asia this morning that Apple and Tesla suppliers have stopped production at some of their facilities in China due to a power crunch. Tom, is that going to be the issue for Q4?
I observed it Friday night. I was at an Apple store on a separate matter, and John, it was thunderous to see how crowded it was with the iPhone 13.
Well, this is it, though, TK.
Stunned.
Demand's great. Can they match it with supply?
Exactly.
And not just for that company. We saw it with Nike last week. How many Nikes will we see through Q4 is a question that Lisa and I were asking on Friday.
John, our audience tearing up, I say, tearing up over the light filtering in for the Southampton Saints and all. We have a guy in Cambridge, Muhammad, emails in and says he was tearing up as well, John.
Yeah, he's not happy, Tom.
The Jets, the Mets, and QPR, which is that's a soccer team.
Muhammad says this was not a great weekend of sports. My Jets got destroyed. My Mets have lost 5 straight and 9 out of 10. And QPR gave up yet another lead and lost.
It's just,
I think Coventry City in the top of the league, Tom.
They are. I believe so.
Just
I
in
noticed
case
that.
Muhammad
I
is
watched
listening.
the entire match.
I bet you did. Equity futures down a tenth from New York City, heard on radio, seen on TV. For our audience worldwide, this is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. In Germany, it may be months before there's a clear picture of who will lead the next government. Olaf Scholz of the centre-left Social Democrats defeated Chancellor Merkel's Conservatives in an extremely close election. Both Scholz and Armin Laschet of the Christian Democratic-led bloc said they plan to head the next government. All the German parties are holding talks in Berlin today to discuss their next steps. China will take further steps to rein in internet companies. A top government cyberspace official told the World Internet Conference that curbing monopolistic behavior and the disorderly expansion of capital are top priorities. He cited the shared economy, online healthcare, and smart delivery as areas of concern. Economists are warning of slower growth in China because of electricity shortages. Nomura has cut its full-year growth forecast for GDP, whilst Morgan Stanley of lower fourth-quarter output. The power shortages forcing Chinese businesses to cut back on production. COVID has cut more than 2 years off the life expectancy of American men. That's the biggest decline amongst 29 nations in a study of the pandemic's effect on longevity. According to the University of Oxford, deaths amongst working-age men contributed the most to declining lifespans in the US. Morgan Stanley has cut Amazon's price target from $4,300 to $4,100. An analyst note says the rising headcount and higher wages would result in profit pressure for the world's largest online retailer. Amazon has risen a little more than 5% this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I want to ask about your experience as a young woman and as a woman working in this sector, and of course having that amount of scrutiny and public attention on you. South Korea doesn't have a very good record when it comes to gender relations, the wage gap, treatment of women. Did you have a personal experience of that deficit?
I was in a mechanical engineering department for 10 years for my undergrad and PhD. Of course, I was just two girls among the 120 classmates in the mechanical engineering department. And then at the time, our workshop building, we even didn't have a female bathroom. So when I watched the Hidden Figures, that was so sympathizing with my experience, because I should go all the way to the campus to go to the female bathroom out of the building. But I really want to see the tendency of the development rather than the current status.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Typically, the fourth quarter of the year, which we will start next week, is the strongest by far for the S&P 500. It tacks on usually on average over the last 30 years, 4 to 5% in the fourth quarter. Investors could be underestimating how strong the finish to the year could be. I would be careful about underestimating the return in the fourth quarter this year.
Darrell Cronk there of Wells Fargo from New York City this morning. Good morning. Tom Keene, Lisa Bramage, Jonathan Ferro. Your market looks like this. Yields higher by 3 or 4 basis points on 10s to 148.71, approaching 150. Euro dollar a break of 117, 116.93. Dollar stronger out there off the back of that story in the bond market. And crude, Tom, we inch higher again. We're through 75 on WTI, up by 1.41%. Crude, $75 and about 2 cents.
Yeah, 75 levels different than a 74.99. A nice lift in oil this morning. Right now, we're going to rush to David Wilson and important observations on China and equities. David, what do you have?
Alibaba Group Holding. That's what I have. You know, I saw a Twitter post on Friday from Charlie Bolello over at Compound Advisors comparing the market value of Alibaba with Walmart. And, you know, you look back several months, I mean, Alibaba had a much higher value, but that's turned around. It's really a function of what we've seen in terms of the efforts to kind of rein in Chinese tech-driven companies. You've got Alibaba's market value down 54% from its peak last October. So, you know, you're talking about a year, and this company, which was twice the size of Walmart when you looked at market value back then, is now even smaller now, below $400 billion, and Walmart's pretty much right there.
One final question in our busy segment here. David Wilson, now what for Alibaba? Do we have any visibility on what they're doing?
Well, I mean, that's the challenge. You know, they have so many pieces of their business. I mean, they're having to back away from media, for example, because the Chinese government's basically telling them they have to. So, you know, that's the question. It really comes down to how much leeway can this company get from the government, arguably. That'll determine, you know, what lies ahead for them.
Very good. David Wilson, we're going to have to leave it there this morning. Right now, and this is very, very important, and this is south of the USS Iowa Battleship Museum in Los Angeles. The Iowa took on all sorts of duties in World War II and on to Korea as well. Fighting the great battle of our supply shortage is the port of Los Angeles, of course, just to the edge there of Long Beach. Ed Ludlow has really been looking into the actual dynamics of what's actually happening with our exports and imports at Long Beach. Ed Ludlow, what have you learned?
Yeah, well, behind me, you'll have to take my word for it, Tom, because it's dark, but in the San Pedro Bay, there are around 60 to 65 container ships at anchor awaiting a berth. Simply put, they can't unload the containers quick enough here in the port of Los Angeles. The more worrying statistic for market watchers is that the time they're spending out in the bay is growing, currently at 9.5 days, which is a record by some distance. And there's so many factors that account for the backlog here. Part of it is simply COVID-19. There are restrictions in place that are slowing down the process. But the supply chain is not just sea containers, right? Once they unload the containers, they need to go somewhere. And we're seeing the same backlog across road and rail. I took the 99 East from San Francisco to Fresno over the weekend, Tom, and along the way, along rail lines, there are miles and miles of trains parked, not moving, stacked full of containers. And that is the problem. This is the bottleneck for America. 40% of our container imports come into this port and 30% of our exports go out. And there's not a lot of movement going on, as you can see behind me.
So, Ed, I'm sure you talked to a lot of people who are in this industry. How long will it take to move through some of this backlog, given the fact that it's been going on for a while?
Yeah, I think the consensus, the average consensus is the end of next year, 22 into 23. We're going to speak to Port of LA CEO Gene Soroka later today, but his forecast is the beginning of 2023, partly because the data shows things aren't improving in any manner. They're actually getting worse. The duration of time it is taking to get a container from China into North America. Input costs, as you guys discussed in the last block, are rising significantly. There are some sanguine voices out there. For example, Morgan Stanley had a note out last week that said things will start to improve. Those higher input costs are being offset by that insatiable demand from consumers that you guys are talking about, and then corporate America and corporate Europe being able to basically command higher pricing to offset it. But it is worrying, and as I said, the data is not pointing in the right direction at the moment.
How realistic, Ed, is onshoring, the idea of companies actually building supply chains that are more domestic, because this is going to go on for several years?
This is the main question I've got for Gene Soroka, Port of LA CEO, because if you speak to container liners, the guys actually carrying the containers, they'll argue that the biggest takeaway of the COVID-19 pandemic and what we're seeing in global supply chains is an infrastructure shortcoming. It's not their fault what's happening. It's the Port of LA's fault, because they don't have the adequate acreage to deal with all of the volume that's coming in. You know, the way that experts have described it to me is that everything on a supply chain is in perfect synchrony in normal times. You know exactly how long it takes to move one consumer good from A to B, but when you have a delay or a shutdown, it then sets everything back in an unquantifiable way.
And I don't want to channel Father Barry of On the Waterfront, but let's do it, and let's talk about the elephant in the room. Is this about the unions and the love of a lousy buck?
Look, we've seen in the Port of Los Angeles, 2012 being a very specific example, where walkouts brought this port to a halt. The biggest issue on the labor side is a shortage, as you guys have been discussing for weeks now, and also the issue that this kind of lower pay, lower skilled labor is being taken elsewhere. Don't forget, this is just the arrival, the destination. You've got issues at the point of origin as well. 7 out of 10 of the world's biggest ports are in China, where policymakers won't hesitate for a second to shut down a port completely, simply to prevent the spread of the Delta variant, which is a big issue at the moment. So part of it is what's happening here in Los Angeles, but the delay, the backlog, is just a series of events that are starting in the main export markets of the world, which of course are in Asia.
Ed, thank you. What time's that interview?
The interview's coming up 8:40 Pacific time, 11:40 Eastern, John. Thank you.
Looking forward
John,
to it,
he
Ed.
can't do the time
Thank you,
change on
sir.
that, you know.
Ed Ludlow can do that. He can add up, Tom.
It's very early. Come on.
Ed, go on. Thanks for your work, mate. Appreciate it. This from Facebook. Instagram to pause work on Instagram Kids. Gives them the time to work with parents and regulators. They say it's not an acknowledgement that the project is a bad idea. For many people who might have read the Facebook files in a Wall Street Journal over the last couple of weeks, Tom, there are many people out there who do think it is a bad idea. The company saying they are to pause work on Instagram Kids. The news coming from Facebook this morning.
Where's TikTok for kids?
TikTok for kids, Tom?
Yeah, that's
no
a big,
idea.
To me, that's a bigger risk, frankly.
You think that's a bigger? Why is that a bigger risk, Tom?
I just look at the usage at home. I think TikTok is like, you know, something parents don't know about.
Okay, Tom
That's how I
King.
put it.
Lisa, you got a comment on this?
I think that it's incredibly revealing, the note that the Wall Street Journal published, the idea that every parent is worried about their kids developing bad body images or anything like that as a result of Instagram. We don't know the long-term implications.
My kids have images of a bad body image. They just look at me and that's their...
I'm not commenting on that, TK. I'll let that one slide. Tom Keane.
TikTok for kids. I mean,
Lisa
I really
Brawitz.
wonder.
Jonathan Ferro. Thanks for the value add, Tom.
Thank you.
Futures down 5 on the S&P with negative 0.1%. Yields up 3 or 4 basis points on 10s, 148.71. This is Bloomberg.
The electricity subscriptions, it's a part of this new business area that we have called the clean energy services. So the purpose for this new business area is to contribute and to create this biggest movement in the world for renewable energy. We will add even more products. We have solar panels that we sell, and now we have the soon, I should say, the electricity subscription. So it really fits that ambition that we have to, within the frame of life at home, the most important place in the world, we can add more value to our customers to live more sustainably. And this is a big part of the climate positive strategy that IKEA has for 2030, that we will remove and reduce climate emissions more than we emit in our entire value chain.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When you went to Harvard Law School, did you say, maybe someday I'll be on the Supreme Court?
Anybody who thinks maybe someday I'll be on the Supreme Court, I don't want to say there's something wrong with him, but there is something wrong.
The great exit, if you will, from these emergency policy settings has begun.
The ECB is curbing their PEP purchases. You know, the BOE wants to raise rates. The Fed's moving towards exit.
The 10-year Treasury is probably right about where it should be based on where we're headed.
The Fed's already positioned itself behind the curve vis-a-vis the last cycle.
The Fed has said it's going to let inflation run, but against that, I would say inflation is running at a pretty furious clip.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Not your average Monday on radio, on television. John Farrow is our guest at the top. Say, is this the great American exit?
Is it the start of the tightening cycle, and how loose will that tightening cycle be? TK yields approaching 150 on 10s at about 149. And for equity investors, for anyone pro-risk right now, what's the tolerance level here? 160, 170, 180? We stalled out at 180 back at the end of March, Tom. How much has changed since spring?
We frame the debate here, and the uncertainty is not only where we are on resistance and support, depending on what you're looking at, but the resistance and support of legislation in Washington, John.
The policy mix, building, teeing up a vote for Speaker Pelosi a little bit later this week, Tom, advancing a story. That's part of the mix here, isn't it, going into 22? Going into 22, how much of this policy effort fades on fiscal, on monetary policy, and can earnings keep doing the hard work? Because earnings have done the hard work this year.
And maybe on this Monday morning, Lisa Abramowitz is chief financial officers and what they do with the yield move and the coordinated slope move as well. Steeper yield curve making the bankers happy. But what do we see, Lisa, about issuance into Q4?
Well, right now, a lot of companies do not need to issue more debt, and they're entering the quiet period when it comes to stock buybacks, so they don't have any necessity on that front either. But look, borrowing costs are still very low, and there's a key question: at what point will these higher yields, with the backdrop of the great exit, lead to actual tighter credit conditions? Not yet, not even close.
John, the real yield here, whether it's off the German election and we see the Swiss 20-year, or what we see with the German real yield, the U.S. real yield, John, gloom, negative 1.00%, a lesser negative number, negative 0.86%.
Back to 86.
I think that's good, right?
Do you think we can get back to zero?
No,
do you think we can get back to zero without causing that equity market some problems?
No, and we heard from Jim Caron, I believe it was, on that brilliant interview we did in the 6th hour with Mr. Caron. I mean, he's only suggested you get so far back.
Well, this is the question, isn't it? And I asked it moments ago. The tolerance level of this equity market for higher yields. How self-limiting would a sell-off actually be? For the nominal yield, I don't know. Is it pushing 2%? For the real yield, can we get anywhere near zero on a 10-year? Maybe we can. I don't know, Tom, but we've got to ask the guest that question.
And Lisa, very quickly here before we get to the data and then to our esteemed guest, $80 Brent crude, we're almost there.
And what is the effect on yields, right? Because there is the sense that higher oil prices means higher inflation. Wow. But at the same time, this will actually crimp people's spending ability. This is not necessarily good for growth. I mean, I'm trying to sort of tee up these ideas and understand the ramafications for the economy.
I'm going to tee up red and green on the screen. John, as you mentioned earlier, NASDAQ off higher yields takes it further south, and negative 0.7%, NASDAQ 100.
149 on 10s right now, yields high by 3 or 4 basis points. And off the back of that, Tom, we look to the equity market. Futures on the S&P down 0.2, on the NASDAQ 100 down 0.7%. It's in big tech, Tom. You're starting to see this play out a little bit more. We're softer there by a big margin compared to where the S&P is right now.
Morgan Stanley with a markdown on Amazon. I actually went back and looked at what does that mean out 16 months, end of 2022, off their new 4,100 set, and it's still an Amazon that advances 16-ish% as well. So that's a markdown on their overweight on Amazon. Right now, we overweight on what really is going on, and that is in the bond market. And we start this hour strong. Gene Tenuzo joins us, global head of fixed income, Columbia Threadneedle. Gene, do you make portfolio adjustments now that we've seen the shift in the fixed income space?
Yeah, thanks, Tom. I think this is an important time, actually, for the bond market. We didn't get a lot of new information from the Fed last week. We thought the taper was coming, the market did, and the taper is certainly coming. But I think what we got, which was a surprise, is that we didn't get this separation in the language as strongly as we expected from the tapering to the rate liftoff. And Powell told us at Jackson Hole that there would be a substantially more stringent test for rate liftoff, but what we saw was really one and the same. So that's, I think, putting a floor under how low yields can go. Do you adjust portfolios based upon that? Well, I think the good news from what we've seen so far is that we've seen rates up with credit spreads tighter and with stock prices higher. So it hasn't been the breakdown of diversification. This has not been the 2013 taper tantrum. So the short answer is no, don't revisit your portfolio strategy. Just be a little bit more defensive on the interest rate side.
Gene, where on the curve has got your attention right now? We've seen a real adjustment on 5s, seen a real adjustment on 10s, 30s. What's got your attention at the moment?
Yeah, John, actually, we feel more comfortable with the 5 to 7 year part of the curve. I think if you look at what is priced for Fed expectations, it's actually pretty reasonable. It's pretty much in line with what the Fed itself is forecasting. It's that longer end of the curve where we're a little bit more nervous. And if there's an anchor or sort of a force of gravity out there, it's relating the 30-year yield to the Fed's long-run dot, which sits there at 2.5%, still 0.5% away from where we are today on the long end. So I think the gravitational pull will be for the long end yield to move higher, and we're a little more defensive there.
You think we can get back to 2.5? You think we can reach that long-term dot over at the Federal Reserve? You think that's ultimately achievable, Gene?
Absolutely. You were talking earlier, can we get real yields back to zero? I don't think it's a 2021 event, but I think that's the path that we're on. And if we get there more quickly, it's the old adage that speed kills, and speed kills in the bond market is eventually that's what pinches financial conditions. So it's not that rates can't move higher, but it's that velocity, that speed with which we saw yields rise back in the first quarter that was really starting to pinch. So if we can see a more gradual move, that would be much more digestible at this stage.
Gene, how much does the international picture color your call for the 30-year bond yield, given what we're seeing over in Europe?
Yeah, thanks, Lisa. It might actually be more important, to be honest with you. I think, again, last week, the new information from the Fed was more in body language and posture than anything substantive. But if we listen to the Bank of England and the fact that they're pivoting to a more hawkish policy, that we might see, a removal of liquidity from the European Central Bank, I think that global backdrop actually plays a significant role in this idea that the wave of liquidity is starting to wane, and I think that doesn't support the long end the way it has in the past.
Gene, what if international buyers step back to the degree that they did in the last 10-year reopening that we saw, and domestic buyers have to pick up all the slack for the Treasury market? What happens then?
Well, I think that's been a debate for a decade plus now, and that risk is always there. I think the pressure release valve is probably not the yield as much as it is the value of the dollar relative to other key crosses there. So I think that's one where you don't want to stick your neck out too far from a currency risk perspective. I don't think that's going to be the key driver of yield and treasury prices here, because what we're seeing is that currency hedged treasury yields are still actually pretty attractive to other developed market buyers.
Let me ask you this, and on the buy side, you're at a whole different viewpoint on this. What is a 10-year yield in your head where you signal what James Bullard would call a regime shift? Are we here, or is it a higher yield?
I don't think we're anywhere near a regime shift yet, and I think we'd have to be in a place where it looks like the market's really getting disconnected from what the Fed is saying. If you look at what the Fed's projecting, we're talking about whether or not we're pricing in a couple, 3 hikes out to 2023. That's pretty modest, that's pretty reasonable, and the market's not far away from the Fed there. If we start to see the market really push the Fed higher, I think that becomes problematic. That's your James Bullard regime shift, and I think we're a long way from there, but that's an environment where 10s are well above 2%.
Hey, Gene, always good to catch up. You're fantastic. Gene Tenusa there, the global head of fixed income at Columbia Threadneedle. Story just out from Matthew Boesler of the Bloomberg team on Charles Evans. Just want to reiterate what Charles Evans of the Chicago Federal Reserve will say a little bit later this morning, Tom, in prepared remarks for a speech a little bit later, I do not think the supply-side induced transitory surge in inflation we are seeing today will be enough to do the trick. I expect that we will need a period of sustained monetary policy-induced overshooting of 2% inflation to boost long-run inflation expectations, enough to deliver on our mandated goals. Voting member this year. A lot of Fed speak in that line, though, Tom, and I would just say as follows. For the Chicago Fed President, Charles Evans, they don't seem to be there yet.
Well, they don't seem to be there yet. You know, I have a huge respect for President Evans of Chicago. And, John, I'm just going to suggest he carries some weight. And, you know, within the Fed speak that we have, again, as we said to Gene Tenuzzo, at what level do they change their tone? We have not broken out of so many trends. We're just at the point of those.
Do you mean
trends.
from the bond market, Tom? Because if you're talking about the bond market at the start of the year when yields broke out, when we really started to see yields break out, the line was it's consistent with a better outlook for this economy. They were comfortable with that. They were comfortable with things all the way through to 180. We're at 149 right now.
Yeah, well, I'm looking at, you know, we do this, and John and I do this, folks, all the time. For those of you on radio, he talks, and I'm bringing up, you know, the 2 standard deviation chart on 10-year yields. And, John, to your point, 3 days in a row, we're beyond 2 standard deviation, move to higher yields.
You think it's the pace that's going to get their attention a little bit more than the level?
Absolutely, it's rate of change. It's first and second derivative dynamics. And the fact is, I'm observing 3 days in a row outside that 2 standard deviation comfort zone. Is that enough math for Monday?
That's enough for now. Yields up, Lisa, by 3 basis points to 149.
I think the Charlie Evans comments really highlight the point that BlackRock's Jean Boivin was talking about, the sort of shallow path of rate hikes when they actually do start raising rates, because they do expect this to largely be, and I know this is a dirty word, but transitory. There's nothing really to give them a sense that we're moving beyond what we've seen for the past decade or two.
They made it a dirty word, didn't they?
They did.
Just on repeat.
I feel a little dirty.
Do you?
Transitory.
Okay. Tom Keats, Lisa Bramwitz, Jonathan Ferro. Your week ahead, Chairman Powell, Secretary Yellen coming up tomorrow.
It will be Friday.
A lot of central bank decisions this week as well. One from the Central Bank of Mexico. U.S. data on Friday, some ISMs.
You got
an earnings season, Tom, 2 weeks away.
You got the Central Bank of Pelosi. She's going to weigh in this week as well.
She's going to weigh in. There could be a vote there on Thursday. Futures down 11. We're negative 0.2%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Facebook is pausing work on Instagram Kids. That's its project for people under the age of 13. The company says the halt will give it time to work with parents, experts, policymakers, and regulators. Earlier this month, several members of Congress wrote Facebook urging it to drop Instagram Kids entirely. Reports have suggested that Facebook knew that Instagram could pose risks to teenagers. In Germany, Olaf Scholz of the centre-left Social Democrats says he hopes to form a government by Christmas. The party won a narrow victory in yesterday's election. Scholz is calling on the Greens and the pro-business Free Democrats to join him in a government as soon as possible. Meanwhile, Armin Laschet of Chancellor Angela Merkel's Conservative bloc insists he will also seek a deal with the Greens and the Free Democrats. House Speaker Nancy Pelosi is promising to pass President Biden's $550 billion infrastructure bill this week. She's also signaling that the headline number on the administration's spending and tax package will be lowered from $3.5 trillion. A split between moderate and progressive Democrats has set up a showdown over the president's economic agenda. And in the UK, pressure is growing on Prime Minister Boris Johnson to do something about a supply chain crisis that has led to fuel shortages. Pumps ran dry at some gasoline stations because of panic buying. The government has temporarily suspended competition rules and allowed companies to coordinate fuel supplies to the most affected regions. Meanwhile, Johnson has done a U-turn, relaxing those immigration rules for foreign truckers. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
They don't need a single Republican vote. Republicans can't stop it. It's not subject to a filibuster. And if they want to do this, they can go ahead and bring the attention of the American people to the increase in debt that we're going to need to pay for this spending spree.
The Republican Senator there, Pat Toomey from Pennsylvania, on CNN over the weekend. From New York City this morning, good morning. Tom Keene, Lisa Bramage, Jonathan Ferro this Monday morning. Your price action shaping up as follows. We're slightly negative. We're down 11. We're off by 0.25%. It is worse on the NASDAQ. The NASDAQ 100 softer, negative, lower by 0.75%. Yields are breaking out again. They're higher by 3 or 4 basis points, approaching 150. Off the highs of the session, still close to 149 at 148.71. Euro dollar might get your attention. It's a break of 117 at 116.97. We're down 0.2%. We're trying to put together some kind of coalition over in Germany following inconclusive elections over the weekend. In the commodity market, once again, we add some weight to the crude price. 5 weeks of gains, and we add some. We're back through 75, Tom, 75 and 35.
Moving to $80 on Brent crude. We're not there yet, but right up to new highs here moments ago as well. Right now, joining us on the political moment and what it means for economics, finance, and investment, Gregory Valliere joins us with AGF Investments, always astute on the moment at hand. Greg, I am dumbfounded by Democrats taking a victory now like it was 64-65 in the resounding win of LBJ. Lyndon Baines Johnson, off of the assassination of JFK, took 61% of the vote. Biden took 51.3% of the vote. How much of a majority does a president have to ram through this set of legislative pieces?
He doesn't have much, Tom. I think that is one of the big realizations over the last weekend. Nancy Pelosi, of all people, said that we're not going to be at 3.5 trillion. That was a big concession, in my opinion. And then she threw out another concession, Tom, and that is that we're not going to have a government shutdown at the end of this week. They'll do an extension. So those two things make me a little more optimistic. I'm not euphoric, but I think the chances of a major crisis are still remote. And then one final point, I urge everyone to read the Wall Street Journal piece on the Fed's tools. If we were to have a real debt crisis and a default crisis, the Fed has options. They can sell some of their treasuries. They can buy defaulting treasuries. So this is a serious story, but it's not an apocalyptic story.
Mm-hmm. Greg, very importantly, do you sense negotiations that are normal, that they have a give and take and a back and forth among well-meaning politicians?
No, I don't see it yet. I think that there's a lot of anger at Mitch McConnell because the Republicans spent like drunken sailors for 4 years with tax cuts and a lot of spending. I think there's a lot of resentment toward him. Right now, frankly, I think the negotiations that really matter are among Democrats. You've still got to get a handful of very important moderates on board. That's coming, but I think a deal with the Republicans comes later in the fall.
Greg, you mentioned this Nick Timiraos story in the Wall Street Journal. Let's go there. This idea that the Fed could be thrust once again into the political spotlight, actually taking a role in trying to stave off a political default. how much is this a risk for the Federal Reserve that when Congress stalls out and can't get stuff done, the Federal Reserve has to sort of be left holding the bag and takes a lot of heat as a result on all sides?
Yeah, Lisa, it's a good point. They dread this. They don't want to get an image of being the lender of last resort. And I think they would make it clear this is an exception. But you read the piece that they've been there before. They've considered these options. There's a lot of controversy with them, including some of the active traders at the Fed. And now there's going to be controversy over this. Well, that's just the way things are right now. It's a very controversial, dysfunctional period in Washington.
It's the way things are, especially at a time when Fed Chair Jay Powell is up for the potential renomination by President Biden. There's a question, though, here, how much inflation is starting to concern Democrats more than it had previously, and perhaps this is one of the reasons for some of the concessions that Nancy Pelosi made. Do you really feel like that's the case?
Yeah, I think that more and more voters around the country are linking together higher prices and big spending. I'm not sure the correlation is there, but the voters believe that. And as long as they do, I think a price tag like $3.5 trillion is just too rich.
Greg, I was looking at Ed Case of Hawaii. It's a hugely Democratic state, and he is clearly a moderate Democrat as well. What does Speaker Pelosi have to offer moderates, blue dogs, like Ed Case of Hawaii?
Well, not a lot, Tom. That's one of the problems here. Maybe she's going to offer him a better chance of getting reelected. An awful lot of Democrats I talk to, or their staffs anyway, are saying they're scared about 2022. The issue is not will the Republicans win the House. The issue is by how much will they win the House, by 10, 12, 15, 20 seats? When you start talking about numbers like that, a lot of people like the gentleman from Hawaii run for cover.
So just before we let you go, you said that $3.5 trillion plan is a pipe dream. Even Nancy Pelosi said that. What are you seeing in terms of what the likely bill will look like in terms of size and in terms of taxes?
Well, under 2. But there's so many gimmicks. Some of these programs are 5 years, some are 7, some are 10, some will expire and then get shoved off to the states. There's a lot of gimmickry, but I think that let's say something more around 2 is far more likely, and it's not imminent.
Greg Valliere of AGF Investments. Greg, thank you. On the week ahead and beyond, Tom, the week ahead's a tricky one to call. Could get a vote this coming Thursday, according to Speaker Pelosi. Then on to next year. And your question about the midterms, Greg's reaction is not about whether they lose things, Tom. It's by how much.
I love the way he extends the timeline. That's the Valliere experience there, John. And, it's not that we shouldn't be hysterical about this week. It's a huge, huge week. But I like the idea of process here. Where will we be in October or December away from those important Fed meetings?
Where will we be at the end of next year, Tom? What does it look like? What does GDP growth look like at the back end of next year? Goldman, Jan Hatzius, what are they going with? 1.5 to 2? Back end of next year?
Yeah, this is important. This goes to Ferroli, who we talked to on Fed Day, John, and he reaffirmed mightily his potential GDP call of about 2-ish.
2-ish.
Yeah, and, frankly, he tilts that a little bit down, which... I can't say that on TV. I'd get in trouble.
Lisa, that's the question, isn't it? How quickly we get back to that trend growth of 2. Whether we can sustain this above-trend story through much of next year.
This is such a confusing backdrop. I mean, you think about the national picture with all the savings and whether people can actually spend the money on goods that potentially are hanging off the coast in ships. And then you think about China slowing down and the bleed through to the United States. And then you think of the stimulus, and it's enough to make your head spin.
You're like the Red Sox.
No, even
John, it's the pendulum of 2-ish.
The pendulum of 2-ish.
It's the pendulum of 2-ish.
2's in the middle?
Yeah. No, that's the debate, John. You nailed it.
I just wanted to try and make sense of what you're saying.
You could be the new chancellor of the Exchequer.
Does anyone want that, Tom?
You got to root for Southampton to be
Tom's been trying to send me back to London for the last 6 years.
That's right.
Tom Keane, Lisa Bramis, Jonathan Ferro. Your equity market's shaping up as follows. On the S&P, we're down 15. We're negative 1/3 of 1%. Nasdaq futures, a whole lot softer. Lighter, lower. We're negative 0.9% now on the Nasdaq 100, with yields breaking out through 150. There's your move. 150.27.
That's a big move here in the last 10 minutes.
Yields higher by 5 basis points from 112.58 at the start of August back through 150. More on that bond market breakout in just a moment. From New York, this is Bloomberg.
boosters work, and they will definitely help. The boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? Should probably up that some. You get infected 3 times, your immune system is like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Oil prices are up since your Concho deal, but some are saying that that is too high of a price. Maybe you paid a little bit too much. How did you come to the right valuation?
That's what's great about our cost of supply framework inside our company, because it's agnostic to price. So to fit our framework, Alex, the all-in cost of supply needs to be below $50 a barrel WTI.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
So much to get through from New York City this morning. Good morning. Let's start with the price action through 150 on 10s. Yields look like this: 150.10 on a 10-year yield, up by 5 basis points from 112.58 in early August back to 150 on a 10-year, with some better than expected data for the economy in the United States. So this is what we're going to do. We're going to go through the economic data in America. We'll work our way through the bond market. Then we need to get some important news from the Boston Fed. Mike, let's start with this economic data. Durable goods, an upside surprise.
An upside surprise for the headline. We're still waiting for the capital goods numbers, which is what goes into GDP and what people really care about. But it is a 1.8% increase for the month of August. That's after a 1/10 decline in July. The expectation was for a 7/10 increase.
The yields pick up off the back of it by 6 basis points, now approaching 151 at 150.96. The data better than expected on capital goods as well as durable goods this morning. Yields higher. That's the story in the bond market. Mike, I think we have to pause for what's happening at the Boston Fed. The Boston Fed president, Mr. Rosengren, has been there for as long as I can remember. I think more than a decade, Mike. And he's stepping down a full 9 months early. We have to be very careful about jumping to conclusions and just go straight to the statement from the man himself. What is the Boston Fed president saying, Mike?
Well, he is resigning as of Thursday. Now, he was set to leave the Fed in June of next year because his mandatory retirement age was coming. But Rosengren says that he has a kidney problem that has been longstanding, and he has been placed on the kidney transplant list. And the COVID situation only exacerbated his health condition, and so by resigning, he will be able to take care of his health better while he waits for a kidney. Now, the problem for this, for Rosengren is that, of course, he's caught up in this issue of trading assets during the financial crisis, during the COVID crisis, when the Fed was buying and selling some of those assets. So when you connect the two, it doesn't look good. It looks like he is being forced out or resigning because of the asset issue, but he is resigning, he says, for health reasons.
Nicely said. This is a guy back to 2007. As John mentions, it's been an incredibly long tenure. The gentleman, Mike McKee from Colby College with Wisconsin PhD economics. And it's been an important voice. Let's link him away from his illness and serious issues with a kidney transplant with Mr. Kaplan of Dallas. What is your reporting, particularly with the National Association for Business Economic meetings going on right now? What's your reporting of the pressures for these two to resign?
Probably some pressures internally, but the problem that they have is that this was all cleared by ethics officers. They all asked in advance, so it wasn't like they thought they were doing something wrong. The appearance is bad, and obviously people will make their own conclusions about whether or not there were any profits made here. There is an internal investigation at the Fed. The question is, does that internal investigation turn up anything? You never know with internal investigation.
Christina Paxson, the president of Brown University, I'm reading this off the Good Boston website. Bruce Van Saun of Citizens Financial Group. Every regional board has that local constituency. Who holds the decision-making on this ethics debate? Is it Powell, the governors, Washington, or is it President Brown of the president of Brown University, Christina Paxson?
It's sort of shared in this case. The board of directors is in charge of hiring a bank president, and they have to submit that name to the Fed for approval to the Fed Board of Governors. The Fed Board of Governors can set rules for the banks, but the banks are quasi-government. They are not, they are chartered as independent companies. So it isn't clear that the Fed could fire a bank president, but they could put pressure on them to resign.
Let's talk about his positions. I mean, he's been known as a hawk, Eric Rosengren, at least in the past. I don't know what a hawk really means, as John has talked about many times. However, he was slated to be a voting member next year. His removal early, what does that do to the composition of the voting members and what the likely path of policy rates could be?
Well, because he's resigning now, there is a very good chance that they will have a new Boston Fed president in place by the time they would vote for the first time in 2022. And so that won't change because the Boston Fed, it's not the president, it's the Fed location that rotates on and off the board. So it will depend on who they choose. Now, I'm sure the next thing we're going to get is that they've hired a search firm and they're going to look for qualified people, et cetera, and we will find out in a couple of months. Now, it's interesting because this all comes to in the time of a diversity movement, and it'll be interesting to see which direction the Boston Fed goes in.
Well, I'm looking right now at the market reaction, and I don't know if this is durable goods. I don't know if it's just something else. I'm giving a narrative to something perhaps that doesn't have this narrative. So just bear with me. But there is a steepening in the yield curve pretty significantly, and I wonder how much this sort of indicates that whoever replaces these Fed members who are leaving or those seats that are empty will be even more dovish than those who are already there, that basically they will let the economy run as hot as possible.
Well, even if you leave aside the changes at the Federal Reserve, it's going to be an issue going forward. And there's a big issue, which we're going to talk about at the top of John's show, about energy prices around the world and how they are soaring, particularly in China, which means supply chain interruptions, which means inflation continues. And you were talking about just before I came on, oil prices going up. Same story. So if we have these supply chain interruptions going on around the world, you're going to have inflation lasting longer. And you're going to have a dilemma for central banks because there isn't a whole lot they can do. Their job is to stimulate demand. So if they think the inflation is high and they want to cut back on demand, can they really do that when the global economy is trying to come out of the COVID crisis? It's going to be, we're setting up for a rough winter whether or not we have another spike in COVID.
Mike, thank you. And thank you for the promo and the tease. You can watch that conversation live and in full. 9 o'clock Eastern Time on Bloomberg TV.
I'll be there.
We're going through some interesting levels in this bond market, so let's reset. If you're just tuning in, some better data out of America, durable goods and capital goods, upside surprise, yields higher. On fives, we approach 1% at 99 basis points, up 4 basis points. On tens, up 6 basis points through 150 to 151. So that's the bond market off the back of better than expected economic data. And here's the announcement from the Boston Fed President Eric Rosengren at the Boston Fed as the president since 2007, announcing an early retirement 9 months earlier than expected, and a really personal letter that he writes to the chairman of the Federal Reserve, Tom. It reads, "Dear Jay, I've decided to resign as president of the Federal Reserve Bank of Boston on September 30th to address some serious health issues that worsened in the last 18 months and must be addressed while working on the pandemic relief programs for money market mutual funds and small businesses. Given the long hours and stress, regrettably, my kidney function declined significantly to the point that I qualified for the kidney transplant list in June of 2020. He goes on to say, Tom, it has become clear that I should aim to reduce my stress so that I can focus on my health issues. A very personal letter from the Boston Fed president to the chairman, Tom, of the Federal Reserve.
Yeah, that's been the Rosengren style here since 2007. John, what I would suggest is everyone has to pay respect for the medical moment, but there is a real sequence here of how will Washington and how will the different regional feds react to this investment upward. Clearly, Chairman Powell has said it's under study, and under further study, it's just the now. And really, we haven't heard from the many boards of directors of our 12 Federal Reserve
Tom, who we need
banks.
to hear from next, and let's be clear from this, we don't want to conflate the issue that the president is having currently with his health, with what has happened more recently over the last couple of weeks. It's up to the president of the Boston Fed. I do not want to get into the business of working out what people are thinking, Tom. That's not a business you want to get in. I can only read out the letter as it reads to the chairman of the Federal Reserve. What will be interesting from here, though, is to hear what the Dallas Fed President Robin Kaplan has to say in the coming weeks as well. That would be a very interesting one to read, Tom, after the cloud of controversy that both of those individuals have been under over the last few weeks.
And with the depths of our economic reporting folks, really over 20, 30 years at Bloomberg, when you look at Michael McKee and the others in Washington, Rich Miller and the team, John, I really want to underscore, particularly for our international audience, the different cultures of the regional feds. To say that Dallas thinks the same as Boston, it's as far apart there, John, as the two football teams. I mean, they really operate and think. They have a character and a historical fabric that is each unique.
It's an early retirement for the Boston Fed President Eric Rosengren. He cites health concerns for the reason for doing that more recently. A cloud of controversy, Tom, off the back of what's happened with investments from the Boston Fed and, of course, over at the Dallas Fed as well. Also need to talk about what's happening in this bond market. Yields through 150. Tom, 151
Nicely
a little bit
through.
earlier on tens, but we need to head down to D.C. to get you up to speed on what's happening with this Federal Reserve, Tom, and the Boston Fed.
Our esteemed reporter Craig Torres joins us here on short notice. Craig, your thoughts on what we would see from Dallas after this medical condition in Boston?
I don't know. That's kind of up to Kaplan and his board. What I would say, Tom, is, boy, we're in for some big changes in the composition of the Federal Reserve. Potentially 4 openings at the board. Now a president, that's potentially 5 new dots. I mean, that's very influential. And all these people are going to be participating in these discretionary areas like what exactly do you mean about by average inflation? Is it 3 years? Is it 5 years? Is it 10 years? What exactly do you mean by maximum employment?
Craig, given all of the openings that we have in the Federal Reserve and given the compositional mix that we currently have on the Fed, what's the likely political pressure to get a Fed official who is incredibly dovish or somebody perhaps who's a little more concerned about inflation and how much the Fed can tamp it down?
For Eric's job?
Yes.
So you're getting into something that's very subtle. Remember, regional feds, their boards of directors put up a name, and the Federal Reserve Board approves that name. So there is a political tension there, but you know, I don't think there'll be political pressure to get somebody who's dovish. I think there'll be political pressure, quite frankly, to get somebody who's diverse. And I don't think the Federal Reserve System is diverse enough. So I think that's the number one issue in selecting a new president.
Craig,
as well as,
how long, just quickly, how long does this usually take to select someone new?
Could take months, actually. You know, John, there are all these formalities like search committees, and then they tend to hire a second firm to do diversity search. So it just takes a long time.
John, can I just say that Craig Torres has been a stranger. We need to get Craig Torres up earlier in the morning.
Well, Tom, you can hear the reluctance in his voice that he came on this morning because he knows he might get invited back. Craig, it's been too long. Thank you, sir. Craig Torres there of Bloomberg News down in D.C. If I ever ask a good question to a Fed official, Tom, that question might have come from Craig Torres.
That would be true. And then
typically that is the case.
You know, bragging moment. This is the depth of the coverage that Matthew Winkler built years ago. And McKee was a big part of that as well with Rich Miller and the others. But, John, to me, the fabric here is how, I can't say this enough, in the battle out of 1912 to the independence of the Fed in 1951-ish, I'm guessing, each bank is different. I can't emphasize that enough.
Elisa, the Boston Fed President Eric Rosengren announcing an early retirement.
And now so much focus on his replacement, given that he will be a voting member, he or she, I should say, next year will be a voting member on the Federal Reserve.
So much focus on the Dallas Fed as well.
Yes,
about
indeed.
What we may or may not hear from Robert Kaplan in the coming weeks. Equity futures, they are softer on the S&P. They are much more softer on the NASDAQ. We're down 0.9%. And these bond yields out 5 basis points, just back below 150, just a little south of that level right now. From New York City, this is Bloomberg.
Companies that can move the fastest and be the most agile, no matter what change comes their way, no matter how fast it comes their way, these are the ones that are going to survive and thrive. China's a good example of that now. You see across the board some of the rules and regulations that are changing, or maybe the uncertainty that's coming out of the Chinese government, and they're trying to deal with some of the local challenges that they have, both in terms of how to manage the asymmetry between the haves and the have-nots locally. They're trying to deal with the issues of managing data and security and other aspects like that. The companies that can operate in China and around the world collectively in a bipolar way are going to be the ones that come out of this on top.
Are investors going to come out on top, though, or are companies looking to do business within China from the United States, are they going to come out on top at the moment, Bob?
Yeah, it's clear that the investors are in for what I think is going to be a bumpy ride. You see it today in terms of what's happening in the marketplace.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
look at states around this country and you see places that are using crisis standards of care, that is not, and that means that we are talking about who is going to get a ventilator, who is going to get an ICU bed. Those are not easy discussions to have, and that is not a place we want our healthcare system to ever be.
Rochelle Walensky, CDC, there with an eventful weekend, again off the booster, and some of the information, disinformation, malinformation, too much information of this pandemic. Time key with Lisa Bramwitz. And Lisa, I scheduled my booster for the middle of October, but for a lot of people, it's still about the unvaccinated.
Yeah, and there are some people, kids ages 11 and under, who still are not eligible. So let's hope that they get some
To me,
too.
that's front and center.
Very much so. I mean, I agree with you that boosters are important
Yeah.
and a big deal, but come on, let's get the kids vaccinated.
We had the Youth of America over this weekend to remind us that the Youth of America is difficult to deal with, and we're hoping they get vaccinated here at some point. We have a rare treat right now. We'll get right to it. Lloyd Minor is one of the most different physicians I know out there. He is someone with world-class first-order research on the balance of the ear. He has taken that over to medicine and the management of hospitals and all, among other things, at Johns Hopkins, a residency at Duke a few years ago, and holds court in Palo Alto right now. What's your biggest headache right now, Dean?
I think our biggest concern right now is to make sure that we continue to provide outstanding health care, that we take care of our students, 18,000 students back on our campus,
Right.
and that we comply with the federal mandate that the Biden administration has issued with regard to the vaccine mandate.
What is your strategy with your unvaccinated staff?
Well, first, Tom, we have a highly vaccinated
What's your
group of people
percentage,
now.
roughly?
It's between 95 and 97%.
Really?
across the
Within
board.
your hospitals?
Within our hospitals, yes.
Very impressive.
And around the university, it's similar. I mean, we're still gathering that information. We want to make sure that we're providing those who wish to apply for a religious or medical exemption, that we provide the avenue to, issue that application and have it reviewed. But we know that these vaccinations are among the safest and most effective vaccinations ever developed. We want to make sure that we answer any questions people have and ultimately get a fully vaccinated workforce.
Meanwhile, Dr. Minor, over in New York State, there is a mandate that healthcare workers get vaccinated, and actually the governor, Kathy Hochul, has said that she may bring in the National Guard to fill empty healthcare roles once this mandate goes into effect, which is this week. What do you make of all this?
It's really important that our healthcare organizations, hospitals, clinics, be able to continue to provide outstanding care. The real tragedy early on in the pandemic was in places like New York, where the healthcare workforce became overwhelmed. We had too many patients overwhelming our facilities and our workforce. So I think having skilled, trained healthcare personnel, if that's the National Guard, then perhaps that's appropriate. But making sure we continue to provide care to patients when they need it by skilled personnel is going to be really important.
Dr. Minor, if there are people who doubt the efficacy or doubt the potential risks of the vaccine, what does it send them in terms of messaging that a lot of healthcare workers are not getting vaccinated themselves?
I think it's a difficult message and one that concerns me a lot. We have a highly vaccinated healthcare workforce where we are, and I think that's true across most areas of the country. The pandemic has been an overwhelming experience for all of us, but I think the steps that the FDA, the CDC have taken to ensure the safety and efficacy of these vaccines are remarkable, and we need to do the best job we can in healthcare to communicate that message so that more people feel reassured and get vaccinated.
Our listeners, our viewers have to be confused by the cacophony of politics, FDA, federal this, maybe World Health Organization, but certainly CDC. What's your desire for CDC and Washington officials to get on the same page?
Tom, I think it's really important that federal agencies be aligned,
right now.
And the FDA and CDC in particular are aligned. And I think Director Walensky, of course, ultimately issued a ruling aligning the CDC recommendations pretty much with the FDA recommendations. But there was, as you described, there was a lot of back and forth with the advisory committee. And it's important to have advisory committees. They represent a diversity of opinions and areas of expertise. But at the end of the day, it's up to the leaders to make sure the alignment's there.
Is this a one-off? Like, is this something new for you with all of your decades of experience, or is this sort of the way the sausage is made within the vaccine bacteria community?
Well, COVID is certainly a one-off for all of us, but and I think ordinarily, Tom, these disagreements do exist in a healthy way between regulatory agencies, but we're in the midst of a huge crisis, and so alignment and coordination is particularly important getting us through this crisis.
Dr. Munner, there was a study that came out of Oxford University that came out this morning that said that American men lost more than 2 years of lifespan as a result of the COVID pandemic. When we look back on this period, what will be the healthcare legacy of the COVID pandemic?
Well, I hope the legacy will be how we responded as a nation and how we responded as a healthcare community. Certainly, there are many aspects of that response that we wish were different. But I think we've all learned a lot and are learning a lot. I am just so proud every day to work with an amazing group of dedicated healthcare professionals where I am at Stanford. And I would say that about really healthcare workers around the country. And supporting our healthcare workforce during these trying times is going to be particularly important as we all get through this together.
Dr. Miner, thank you so much for joining Bloomberg today in New York. Greatly, greatly appreciate it. Lloyd Miner's been with us many, many times here across the arc of this pandemic, and we look for further conversations. Of course, Stanford University School of Medicine Dean as well. Lisa, your thoughts on the immediacy of announcements from the Fed?
Well, yeah, I'm just reading more about the Eric Rosengren resignation, basically speeding up his retirement by 9 months to Thursday on a kidney condition. Of course, there is this question of the potential revelations about trading activity, and now there's more focus on Robert Kaplan. However, very sensitive time. The backdrop to this, though, Tom, to me, is how central the Federal Reserve is to markets, how central each of the Fed officials are to the vote, to the dots, to understanding how the central bankers are thinking about the economy and inflation ahead.
I've always prided myself, Lisa, on not carefully calculating hawks and doves on the incoming Fed where they change voting. But I will suggest this time around is maybe the most important in what I'll call the cliche recent memory. The shift into the next regime of voting could be profound.
The idea of how much do you believe, how much do you have faith in an inflationary backdrop of the future that will necessarily look different than the one we're looking at right now with supply chain disruptions and gas prices that are rising significantly. It's a mystery. I mean, Guessonomics, I keep going back to Danny Blanchflower's term.
Had a ramp up in Brent crude here, just under $80 a barrel here moments ago. Right now, $79.47 on Brent. In the yield space, well, we had a 151, I shall say, on the 10-year, 1.48 right now. So on a micro basis in your morning as you begin your week, some of the churns we see red and green on the screen. The Dow, Farrow didn't quote the Dow for the entire show.
Oh my
God.
God.
What a fail that
Killer.
was. Up 48 points on the Dow, but red and green on the screen and the VIX out near a 19 level. It is the beginning of an eventful week. Stay with us on radio, on television. Good morning.
want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams. There are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and then Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Let's get the week started from New York City for our audience worldwide. Good morning, good morning. 30 minutes to go. Equity futures down about 10 on the S&P. We're negative 0.2%. A bit of pain on the NASDAQ. We'll get into that in just a moment with bond yields breaking out. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. Is the great central bank retreat just beginning?
We're in a very kind of unique period.
Central banks shifting to a more hawkish tone.
A number of central banks that have already either signaled.
Talking about moving towards being less accommodative.
Starting to remove accommodation.
The ECB is curbing their PEP purchases. You know, the BOE wants to raise rates.
The Bank of England potentially hikes early next year.
The Fed's moving towards exit.
They've telegraphed the tapering.
We even see some of the EM central banks raising rates again.
The Central Bank of Brazil tightened 100 basis points. We think Mexico does 25 next week.
We'll know what the deal is.
When that ship turns globally, historically, you're going to get volatility.
This is actually hawkish.
Here it's about the speed of that removal.
This bond market gets your attention this morning. Joining us to discuss is JP Morgan's Kelsey Barrow, BlackRock's Michael Friedrichs, and Tolbaken's Michael Purvis. Kelsey, I want to come straight to you and talk about the rate path in the future. Just how loose do you think potential tightening will actually be?
So the Federal Reserve has set the clock, essentially. At this point, we're not going back. Tapering is going to start, and it's likely to end by mid-year. And we think that yields are biased higher. There's been some unusual price action most recently. If I look at since June, you have the 5-year up 15 basis points, and you have the 30-year down 30 basis points. We think that type of price action, it's called the twist flattening in the curve. We think that's really unsustainable because we do not view the Fed removing accommodation as a policy error. This is completely appropriate based on the growth and inflation backdrop.
So, Kelsey, your call then is for yields to continue moving higher from the front end through the belly, but also through the long end as well. 10s out to 30s.
Yes, I think there will be a limit to how high yields can go, particularly in the 30-year part of the curve. We've been seeing really robust demand, even surprising to me at the last 20-year auction, the record high indirect demand that we saw. But nevertheless, you know, when I think about what drives the long run dot at 2.5%, I don't think it should be moving higher from here, but I think the market is still a little bit pessimistic in terms of how it's being priced.
Michael Purvis, 2s, 30s at 2%. That gets your attention, Mike, and the question many people are asking in this equity market is what kind of levels can we tolerate?
From an equity market perspective, look, in the work I do, you know, assuming that we don't see the 10-year yield, soar up to 2% and through that level, and then it's really kind of in this, basically this year's trading range, I think the equity market risk premium, in other words, the forward earnings yield less the 10-year treasury yield, is right now in a very comfortable state that can accommodate substantial further rally here. And I think that applies to both the SPX and other indices like the NDX as well. We have to remember that the rate of change for earnings, likely earnings, is going to be a lot higher than what, as dramatic as this yield jump we've seen in the last few days. The earnings growth story is very much intact, in my opinion.
I'm going to jump in to bring in Michael Fredericks as well. Michael Fredericks, your reaction to this conversation, please.
Yeah, I've got a lot of sympathy for this idea that the rate move is likely contained. I'm kind of questioning what took so long. We've had interest rate hedges on in our portfolio for the better part of the year, so this is playing out later than we expected, but it's moving in the right direction. But I think the point about there are limits as to how high rates can go are true. We see a lot of it at BlackRock, where there is strong structural demand for really safe fixed income instruments from players that we don't always talk that much about, but there are pension plans that need those types of assets, insurance companies, maybe big players that are real money buyers. And as rates move up, I think it may be underappreciated that there is a lot of demand for these assets. So when we look at where the 10-year in the forward rate market, the 10-year, 1-year forward is expected to be about 175. So I'll probably take the over a little bit on that, but it's hard for us to see move much over, say, 2%.
Yield high by 4 basis points this morning to 149 on 10. Do you see the mix in the equity market? That gets your attention too. Equity futures positive on the S&P 500, negative rather. Much more negative on the NASDAQ. We'll get our teeth into that a little bit later in a program. Big week ahead, Katie Lies. Let's get there. Here's Kaylee.
Well, John, there's only a few days left of the quarter, and they are going to be quite full. On one hand, you have a ton of Fed speak. We've already heard from Charles Evans of the Chicago Fed this morning. We'll hear from John Williams of the New York Fed and Governor Lael Brainerd today as well. And tomorrow, we'll hear from the chairman himself, Jay Powell, alongside Treasury Secretary Janet Yellen, who will be testifying on Capitol Hill. Plus, we get a slew of economic data over the week, including durable goods today, consumer confidence tomorrow, jobless claims and GDP on Thursday, and then on Friday, PCE, which, of course, is the Fed's preferred inflation gauge. And, of course, the backdrop to all of this is a market that has clearly shifted back into reflation mode after last week's Fed decision. Obviously, as you were just discussing, that is evident in the bond market with a ferocious move higher in yields. We're back out near 150 on the 10-year, which is there in white. And in the equity market, you're starting to see the small cap Russell 2000 reclaiming some territory relative to the large caps. Of course, the fiscal conversation plays into this as well, so we have to pay attention to Washington this week. And House Speaker Nancy Pelosi has promised to bring that $550 billion bipartisan infrastructure package to a vote on Thursday, hammering out the details of that social spending and tax package as well. But also this week, we face a deadline in terms of getting the government funded. We could be faced with a shutdown on Friday if no continuing resolution is passed. That, though, may not be a bad thing for the equity market, John, because when you look at all the shutdowns we've had throughout history, equities have actually gained during each of them, even the ones that extended for weeks, John.
Katie, thank you. On the week ahead, Kelsey, I want to turn straight back to you and talk about the bond market. We stalled out on 30s, on 10s in late March earlier this year. What's changed? What hasn't changed? And for people out there wondering whether we can push through those levels this time around, what would you say to them?
So I think we have learned a lot since March. On the growth side, I think we've been surprised by how robust demand has been, particularly for durable goods. The consumer in the U.S., can't get enough. They have such strong balance sheets. And on the other hand, we have the supply constraints. And so, it's not a problem, or it's not a bad problem when you see growth slowing because you don't have supply. As long as the demand is there and we're able to rebuild that inventory, it's actually going to be a tailwind for growth going forward.
This supply issue is just absolutely massive right now, Kelsey, and we saw that in Nike earnings last week, that when you have some difficulty finding the supply, demand gets hit, profits get hit. Is the Fed likely to respond to that scenario, Kelsey? I guess that's another issue for us into next year.
Well, I think the Fed is taking notice, particularly as it relates to how this translates into inflation and inflation risk. If you looked at the dot plot, for instance, or the SEPs, it showed 13 out of the 18 participants saw upside risk to their core PCE forecast. And that's already on top of the fact that they are forecasting core PCE above 2% through the forecast horizon through 2024. So they're not ringing the alarm bells. They're not saying inflation is running away from us, but they're saying, yeah, it's appropriate to remove accommodation. We don't need to be buying 120 billion of bonds per month when we have so much demand that we can't even keep up with supply.
Kelsey Barrow there on the bond market. That's the story of the last year or so. Demand's great, supply not so good. And now we've got this power issue in the mix as well, not just in Europe, but in China too. Look at the forecast coming from Nomura. They cut their 21 GDP projection to 7.7 from 8.2. They write the following: even with these cuts, we see more downside risk to our forecasts and expect markets to downwardly adjust their forecasts soon. We had reports out of Asia overnight. The suppliers to the likes of Tesla and Apple have had to close down because of power shortages in China. Michael McKee joins us now, our economics editor. Morning, Mike.
Good morning, John. I hesitate to say good when you talk about this story, because this looks like the next economic crisis, and it's already here. It's not just China, it's around the world. Natural gas prices are soaring, and you can see how Europe in particular and some of the Asian countries have it's just gone through the roof. The U.S. is a little higher, but not as high. Look at the key there, the list of the prices. You can see, and I don't usually put this on there, but you can see how high they've gotten in the $27, $28 range. The U.S. is way below that, but still it is going up. And that means a really tough time for producers going forward. And China, a focus because it's the center of all the supply chains. And the Chinese industrial production numbers have already been flattening. And the PMIs, which are supposed to come out later this week, are expected to fall, showing a lot of manufacturing shutting down at the government's direction because they don't have enough energy. And that means much greater disruptions to supply chains, and that means probably higher inflation for all of these central banks. In some places, it means people may freeze this winter if they can't get natural gas. Now, the U.S. has less gas than usual. You can see the blue and white lines there. The white line is where we are this year. The blue line, the 5-year average, and that's pushed the price up. Looks dramatic on this graph, not as much when compared to the rest of the world, but we've got a problem in that we have the gas, it's just not being produced because shareholders are pushing the gas companies to keep the prices high at this time. So we've got a problem ahead, and John, the problem for the central banks is this is going to crimp supply. It's not something they can do. They can cut rates, but it's not going to produce more gas.
Mike McKee, thank you, sir. On the latest, demand great, supply not so good, costs higher. On costs and margins, going into earnings season, we asked repeatedly last week, how many Nikes will we see over the next 3 months? This from Morgan Stanley's Mike Wilson. He says the following: the spread between GDP growth and wage growth correlates fairly closely with operating margins over time. Based on our estimates, this spread should decelerate in coming quarters, which suggests margins should contract. Michael Fredericks, Michael Purvis, I want your take on the equity market here. Michael Purvis, first to you. On margin risk going into this earnings season, how big is that risk?
I think it's significant in certain facets of the market. For example, some more on the value side. I think it's important to remember when you're talking about the broader equity market, the S&P 500, 40% of that is big tech, where they've had high wages, with their high cost software engineers and so forth, since the company's inception, effectively, right? So they're largely immune to a lot of this margin pressure. That varies a little bit company to company. So I think that's more on the value side of the house, which obviously is a big part of the index as well. But I think it's you also have to think that in the second quarter, overall, the companies blew away not only earnings estimates, but also revenue estimates. And even if the economic data was underperforming, corporates were outperforming there. And there is, even if the nominal GDP story is not a straight line, and it's been, volatile here, there is we are having a real surge in nominal GDP, and that does often help to, that helps to sort of refresh the operating leverage embedded in so many companies as well. So I'm not as concerned about the margin pressure as Mike Wilson is.
Michael Fredericks, are you?
I think Michael framed it really well. We're having the same conversations on our team. So I think it is idiosyncratic, and I think there are some companies that are obviously going to are much more exposed than others in terms of cost pressures. We've talked about all the supply chain issues. We haven't really talked about some of the shipping issues, but transportation costs are a big problem for some companies, not others. But we think about it in a similar way with respect to the nominal GDP backdrop. There's a lot of talk about real GDP and what real GDP might be next year, but nominal GDP is expected to be something like 7.25%. That's a pretty high, spicy level when you think about companies that are reporting sales and earnings growth in nominal terms. You would expect to see, and maybe this is Mike Wilson's point, that that's a great backdrop for sales growth and for earnings growth. So I think the key question is, do you get incremental margin expansion? And I'm more sympathetic to that view than compression at an aggregate S&P level. But I think the way to play it is to try to find those companies that are less sensitive to some of these input cost pressures and focus on those, particularly in tech and healthcare and those types of sectors that can benefit from greater incremental margins on what should be a really good year for sales and earnings growth.
You mentioned the shipping issues. We'll head to LA a little bit later this hour and talk about them. Michael Kelsey sticking with us. Coming up on the program, another crucial week down in D.C. House Democrats moving towards a showdown. From New York, this is Bloomberg.
After 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let me just say we're going to pass the bill this week. I promised that we would bring the bill to the floor. That was according to the language that those who wanted this to be brought to the floor tomorrow wrote into the rule. We will bring the bill to the floor tomorrow for consideration. But you know, I'm never bringing a bill to the floor that doesn't have the votes.
House Democrats preparing to vote on key pieces of President Biden's economic agenda, despite rifts within his own party. The Congressional Progressive Caucus chair saying Pelosi won't have the votes.
I don't believe there will be a vote. The Speaker is an incredibly good vote counter, and she knows exactly where her caucus stands, and we've been really clear on that. The votes aren't there.
The votes aren't there. Joining us from Washington, our Washington correspondent, Bloomberg's Anne-Marie Jourdain. Anne-Marie, the votes aren't there.
Well, they're not there yet, and I think Pramila Jayapal was talking about a vote happening today. That is what Speaker Pelosi had promised, and this deal she worked out with the House moderates to bring up the vote on bipartisan infrastructure Monday, September 27th. But what she is doing is she's bringing it to the floor for a debate with a promise to now have the vote on Thursday. So the question, Jonathan, is now, will they have the votes? Will those progressives, led by Chair Pramila Jayapal, representative from Washington State, will Pelosi have those votes of the progressives come Thursday? Is there enough that she can offer the progressives in terms of an agreement that enough is getting done on reconciliation, a $3.5 trillion package, to offer them? And that's where a lot of questions rely, because they're still negotiating what's going to go into this reconciliation package, and not to mention also an agreement on the top line figure, Jonathan.
Is the debt ceiling an afterthought at this point going into this week?
Well, today there's going to be a vote on that bill that was passed in the House in the Senate. And remember, that bill is a stopgap funding measure to make sure that at 12:01 Friday morning, the government still stays open, but it's linked to the debt ceiling. And we already know Senator Mitch McConnell said that that is going to fail because the Republicans are just not going to vote on that. So potentially this is going to be another drama on top of the economic agenda they're trying to get through. They have to then pass a stopgap funding measure, potentially without the debt ceiling, and then the Democrats, if push comes to shove, are going to be the ones that are going to have to cave to do something to suspend the debt limit.
Anne-Marie, thank you. Anne-Marie Jourdain down in Washington, D.C. on Capitol Hill, on Washington correspondent. Where do you start in Washington? With a deep breath. Michael Purvis, is this a headwind or a tailwind for this equity market?
Well, in terms of the debt showdowns, John, in terms of what, well, I think one thing, if you look at, the spread between 3-month Treasury bills and 1-month Treasury bills, that has been climbing as it has done in the past. In 2011, 2013, 2015, those debt showdowns, you saw that that spike sort of reflecting this, growing anxiety. But I think it's also important to recognize that it has a very limited history of spilling over into asset classes like the VIX or gold volatility, or so forth, even though one might think it should. It hasn't, certainly not in the last two anyway. So I think it's a little bit of it's probably going to be a nothing burger for the broader market discussion this week, even if that tension increases. Obviously, if we do go into a real shutdown mode, then it's going to be, you're going to see a higher, risk aversion there. But again, I think the markets have an incredible way of just sort of plowing through this stuff one way or the other. And
I know,
usually,
and I keep trying to cover it, Michael, and everyone says the same thing. It's a nothing burger. Kelsey Barrow, for you in the bond market, is it a nothing burger?
So far it is, other than the bill market, which Michael just mentioned, is pricing in some stress, some volatility around the X date in the middle of October. People are just closing their eyes and waiting for this all to be worked out. We don't know exactly how it will be worked out, but we're ready for it to be worked out. We'd all love to move forward from this. Overall, when I think about the fiscal trajectory, I still view the fiscal backdrop as supportive for growth. It's going to be less supportive in 2022, but at the same time, we have a lot of pent-up savings that's been accumulated during this pandemic, and I think that's what's going to help us power through and remain above trend in terms of growth next year.
That's the line I want to pick up on, Kelsey, and thank you for it. Michael Fredericks, just how supportive will Washington policy be for growth next year? And how supportive will it be for this equity market when you start thinking about the size of the package and, much more importantly, the composition of it as well?
Yeah, I mean, just a quick note, Jonathan. I was emailing this morning with Kate Fulton, who heads the BlackRock team that focuses on these things in DC, and their strong opinion is the most likely scenario that plays out this week is that decisions don't get made, and that there's some sort of continuing resolution that pushes the debt ceiling issue back towards later in October, so we can enjoy all this theater again, probably in a few weeks from now. But the point around stimulus and the fiscal impulse is pretty powerful. The numbers that we're talking about, we'll see what gets passed, but these are all really supportive of GDP, not just for 2022, but a lot of this money will get spent over multiple years. So we haven't had that type of backdrop in a while, and that happens to coincide with record levels of household wealth. $141 trillion of household wealth. It's literally gone parabolic over the last couple of years. So, I think this is really supportive of the consumer, of consumer-related plays, and we've got a number of those expressions on in our portfolios.
We're all so excited about October now. Michael, thanks for that. We'll talk about how to express that view in the equity market with a little bit more detail in just a moment. Kelsey, Michael and Michael will be sticking with us. Coming up, the morning calls and later. Supply chain disruptions continue. A growing list of companies sounding the alarm on persistent bottlenecks. That conversation still ahead from New York City, with equity futures just a little bit softer on the S&P and a whole lot worse on the NASDAQ. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Three days of gains into Monday, just a little bit lighter negative on the S&P, down by 0.25%. We moved the other way on small caps. We're much more negative on the NASDAQ. The NASDAQ 100 down by 0.8%. One to watch as yields start to pick up again. That's the price action. Let's get you some morning calls. First up with Citigroup upgrading Western Union to a buy. The analyst seeing upside to earnings growth and an attractive valuation following the stock's recent weakness. We're positive there by more than 4%. Morgan Stanley cutting its Amazon price target to 4,100, expecting rising headcounts and higher wages to pressure the company's revenue growth. And your third and final call from Bank of America downgrading Hyatt Hotels to underperform, seeing a bumpy recovery for lodging amid challenges from the Delta variant. That stock is down by more than 1 percentage point. Coming up, Nike, FedEx, Costco, a growing list of firms sounding the alarm on bottlenecks. That conversation just around the corner from New York City this Monday morning. Good morning. The opening bell on a new trading week next.
went to Harvard Law School, did you say, maybe someday I'll be on the Supreme Court?
Anybody who thinks maybe someday I'll be on the Supreme Court, I don't want to say there's something wrong with him, but there is something wrong.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
A brand new trading week starts right now as we wrap up Q3. One of the most surprising things about last week, we ended with a week of gains. Get your head around that. From New York City going into the opening bout this Monday, futures negative down 12. We're off by 1/3% on the S&P. We're down 0.9% on the NASDAQ. That's the opening bout. Switch up the board and get to the bond market. Your 10-year yield through 150 earlier, 149 right now. Fives interesting, approaching 1% on fives. A little bit later this morning, 11:30. $60 billion of two-year notes coming to market. 1 p.m. Eastern time, we get $61 billion of five-year notes coming to market. Some interesting supply a little bit later. In the FX market, it's a break of 117 to 116.99. An inclusive election result over in Germany we'll discuss a little bit later in this program. We're down 0.2% there on euro dollar. And crude, 5 weeks of gains on WTI, up 2%, $75.54. That's the cross-asset price action. Abby, energy flying.
Energy is flying, but before we take a look at that reflation trade on the move, let's start out with big tech, because that underperformance for the NASDAQ really stands out. It has everything to do, of course, with that 10-year yield back above 150 at one point, as you mentioned. Last week's reflation for big tech, this week inflation. Apple, Microsoft, Amazon, $6 trillion worth of market cap, down about 1% or more. Facebook also lowered this, of course, as they say Instagram has paused work on their kids site amid controversy. So that's where the pain is. As for where we have stocks climbing, not surprisingly, it is that pure reflation trade. JP Morgan, Bank of America, both up more than 1%, of course, as yields are higher, helping out the lending business. And there's that energy you were talking about, John. Occidental Petroleum and BP, both up sharply. Occidental Petroleum, 5.5% on the back of crude oil, as you mentioned, now on pace for a 5th week higher.
Abby, thank you. Thank you very much. Energy top of the pile, advancing more than 2%. The S&P 500 negative about 1/4, dragged down by what's happening with information technology, down there by 0.8%. Cassie Barrow of JP Morgan mentioning a little bit earlier this morning, demand's decent. We've got a supply problem. We saw that with Nike last week. Tons of demand, they can't meet it. They've got problems in Vietnam. And what have we seen over the last year or so? Problems with shipping. Shipping costs worldwide are going through the roof. Joining us now from LA is Bloomberg's Ed Ludlow. Morning, Ed.
Yeah, good morning. There's more than 60 ships waiting in the San Pedro Bay just to get a berth here at the Port of Los Angeles. They're waiting 9.5 days, a record level, just to get in port and get those containers unloaded, where they're then met with backlog on road and rail. The manifestation of that, if you come with me into my Bloomberg terminal, is simply spiking, soaring costs for companies like Walmart, Costco, IKEA, who are paying well over the odds to get their containers from Asia into America. Demand is rising at this time of year, John, because you know that there's restocking going on ahead of the busy holiday season. We know that Apple in particular is upset about that blue line, the rising costs you see. And the next screen on your chart, shutdowns in China. Policymakers are not afraid to shut down 7 out of 10 of the world's biggest ports to fight the Delta variant. And that is adding to already high input costs for these guys, including fuel that you guys were talking about earlier on the show. That's if they even can get here. Remember, at the point of origin in manufacturing, and let's go to the semiconductor sector, we still have growing lead times for semiconductors, up to 21 weeks in the latest data from August. The outlook increasingly distant from when we will see those supply chain issues resolved. So what does this all mean going forward? What is the forecast for the coming quarters? Well, we're going to ask the Port of LA Executive Director Gene Soroka later today, live here at the Port of Los Angeles.
Ed, looking forward to that. That's an important conversation. In the UK right now, back home, for you and I'm sure speaking to family members, Ed, you know, we've got an energy problem, but most people would say we've got a labour market issue. Do we have a labour market issue in that port behind you? Do we have a union problem?
There's a shortage here, and there's a shortage for the trucks that pick the containers up. The union has a 5-year contract here that expires in the second quarter of 22. If supply chain problems are to persist into the second quarter of next year, then those that I've spoken to say the union could use that as leverage to get a better deal. Remember 2012, a big walkout here in the Port of LA that basically ground the place to a halt based on union dissatisfaction. John.
Ed, thank you, sir, as always. Ed Ludlow from the West Coast. Michael Fredericks, you wanted to talk about it. I promised you we would. Here we are. Shipping costs, shipping. Does this shape your view, how you express where you want to take risk in this equity market? To what degree?
Well, look, there's a confluence of things that are exacerbating, which was already a pretty tough situation with shipping costs. And you're seeing more and more anecdotes, John, that you mentioned with earnings releases and so on. Look, this is going to be with us for a while. The semiconductor shortage is going to be with us for multiple quarters. So it's going to take a while to get through this. So not great headlines. And I think this goes back to this existential debate: what companies can pass on these costs and what can't. And I said some positive things about certain companies that weren't terribly impacted by by rising shipping costs in the form of, say, technology companies. I think one of the headwinds is valuation, and with rising rates, we see the NASDAQ down a bit this morning, but I think that does challenge PE multiples for certain sectors as well as the whole market. So my takeaway is we're entering a period where we experienced exceptional economic momentum. We've passed that peak, and it's decelerating. And I just think the backdrop gets a little tougher. We're still positive on risk assets.
Yeah.
We still really like things like high yield bonds and bank loans. They performed beautifully last week, despite all the equity turmoil. But I think it's just going to get tougher as we go forward because valuations are stretched in fixed income. They're stretched in equities. That's not to say that things can't continue to grind higher, but I just think it probably warrants either some hedges or taking some chips off the table.
There's been supply issues all year. Margins have held up. There's been cost issues all year. Margins have held up. Will they continue to hold up? Morgan Stanley out with a really interesting note earlier this morning. 4,100 from 4,300 on Morgan Stanley. They're talking this morning about margins from Mike Wilson, but it's the stock call over at Amazon from 4,300 to 4,100 I want to discuss with you, Michael Purvis. Amazon's down by more than 2%. That's still a bullish price target at Morgan Stanley this morning. But they're talking about a rising headcount, higher wages, pressure on margins. Earlier on, Michael Fredericks talked about positioning for a strong consumer. Michael Purvis, I'm just wondering where you do that. You're bullish. Where do you do that?
Look, I think one thing you have to consider, John, when you're looking at this is that to a certain extent, you want to be in the tech sector, skewed a little bit away from some of these labor price hike risks like Amazon, right? Like in other words, Google might be a little bit more obvious along than say Amazon. On the other end of the barbell, I think there's a lot to be said for having exposure in some materials names, like steel companies, for example, in the U.S. I think have a lot going for them and are still in many respects quite cheap. Cheaply priced there. I think there's a lot of stocks that are in the middle where you're going to see a lot of volatility in their earnings streams over the next couple of quarters as Michael was referring to, as these sort of enduring bottleneck issues trickle through. So I'm sort of at a barbell. I like either sort of very old economy type industries in the material space, or in the very high tech space.
Kelsey, this is relevant to you for the bond market, for the central bank conversation as well. This came from Charles Evans, the Chicago Fed president, this morning in comments that Matt Boesler wrote up a little bit earlier, our team here at Bloomberg. And he said the following: I do not think the supply side induced transitory surge in inflation we are seeing today will be enough to do the trick. It won't get it done. I don't want to make a move based on that. Kelsey, is that your view on things, that this Federal Reserve will tolerate higher inflation prints, even if this story does persist through next year, if it's driven by the story we've just described?
they will be patient and they'll look at the data. And if it is being driven by things that are in their view, transitory, supply chain bottleneck associated, they will try to be patient and look through it. But on the other hand, we're seeing shelter and wages, which are the more sticky, more cyclical components of inflation, also picking up. So I think the reason that they're going to remove accommodation is not going to be because of these transitory factors, but it's because underlying inflation pressures are rising. And when I look at wages, it's like the recession didn't even happen. The line just keeps going up. The bargaining power is with the consumers. And I saw a really interesting stat from the New York Fed that does a survey of reservation wages, the minimum amount that a person would be willing to take to work. It's up 18% since March of 2020 for people without a college degree. So that's what we're looking at. That's what the Fed really needs to be concerned about, not necessarily the supply chain bottlenecks, the inflation in autos we saw last year.
Cassie Barrow, tremendous, and looking forward to getting you back on the show soon. Thanks for your time today. Michael Fredericks, Michael Purvis, thank you to you, gents. Your equity market a bit softer this morning, down 0.4% on the S&P. The pain is on the NASDAQ, down by more than 1 percentage point. Here's Ambi with more.
John, well, the pain certainly is on the NASDAQ, with that index really underperforming as rates going higher, pressuring those high growth stocks and valuation. But where we have gains, big gains, you were talking about energy flying on the open. Let's slice and dice it many different ways, because we have the multinationals really flying. ExxonMobil, Chevron, BP, Shell, all up about 3%. This, of course, with oil above 75 on what some see as a supply crunch, up for the 5th week in a row. Tankers and rigs up too. So it's every sector of energy up in a big way. Take a look at Transocean there, up 5.4%. And U.S. E&P over the last month, all up more than 10% or so, helping to explain why the energy sector is back on top for the year, up 35%, the best on record. But what makes this so interesting, John, if we go into the Bloomberg terminal, we will see both oil and energy flying on the year. Again, oil back above 75. But it appears that the best sector on the year, up 35%, could actually have a catch-up play to oil. There's a big gap there. Let's see if that happens.
Abby, thank you. Top of the pile, energy up by more than 3 percentage points on the S&P 500. Coming up, election uncertainty, Social Democrats edging ahead of the Christian Democrats in Germany. From New York, this is Bloomberg.
There is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia, like Taiwan, where they're having trouble meeting the demand. the supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
From New York City.
We're here in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
The trouble that lots of people have with dealing with Germany is that they assume that it has sort of the same political dynamics as Britain or France or the United States. And that's simply not the case. Germany is a country where stability, where not changing, where being predictable are all the main characteristics that one wishes from the politicians.
By a slim margin, Social Democrats defeating Angela Merkel's Conservative Party, setting the stage for negotiations on who will replace her as Chancellor. For more, let's head to Berlin and catch up with Bloomberg's Maria Tadeo. Good afternoon, Maria. How long is this one going to take?
Well, it's probably going to take months, and that's been made clear. They're hoping, best case scenario, that by Christmas there will be a new government in place. Now, this is what we know, John. We have two parties here that are competing for a mandate. Both say they have a mandate to form a government. What I would note, however, is that this looks from the outside very messy, very difficult. But the one thing to notice for markets is that the tail risk of a left-to-the-left coalition did not manifest. That is not an option that is on the table. Perhaps that explains the reaction in the DAX today. And then secondly, both the Social Democrats and the Christian Democrats are very centrist parties that are pro-European. And the big question for markets going forward is, are we going to see Germany spending now, really deploying more fiscal capacity? The answer to that question is complex, is yes and no. This is still very much a traditionally fiscally conservative country, but at the same time, any coalition will include the Greens and perhaps the Liberals. They both have been very clear that the German economy has to modernize. It has to modernize on the digital front, and it has to modernize on the green front, and that means deploying cash. So we will see more money put to work, perhaps not as much as some investors were hoping for, but there will be change in those two areas, which, by the way, that's also a huge challenge for the German industry, especially as we see the CO2 regulation coming in from Brussels.
Maria, if the FDP, the Liberals, are the kingmaker in all of this, is it fair to say that any additional spending will be constrained by them?
Indeed. And, you know, he is the real kingmaker here, is Christian Lindner. He is the conversation in Berlin today. Now, they will have to go into a real beauty contest to attract him. The one thing that he says is, I'm not too caught up on the black zero, not spending, not new boring, but he said, the one thing is this needs to fit a purpose. It needs to have a reason behind it. So he is fiscally conservative. But again, the key when it comes to Christian Lindner is that he has said when it comes to modernizing the economy, we have to do it. He's also had some interesting comments on China, perhaps saying that Germany has been too focused on that one country, and the industry in that sense should perhaps reach out to other markets, not just focus on China. That could become, in the long run, a problem for Germany, not just for the industry, but also in the foreign policy.
Maria, thank you. She's going to be standing there now for the next several months. Maria Tadeo, out in Brussels, Berlin rather, today for the German election. Joining us now is Allianz's chief economist, Ludovic Subram. Ludovic, let's start here. How wide are the potential coalition outcomes that you can see? And how narrow are the potential policy outcomes that you can see off the back of it?
Well, you see, you answered the question in your question. I think it's the optionality is very large. We see at least 3 potential coalitions, but I think it's an evolution and not a revolution when it comes to policy outcomes. And this is a bit unfortunate because, as you know, Germany really needs a new start. So it's quite interesting to see that we're going to have months of uncertainty, and clearly the kingmakers are the Green and the Liberal parties. But I expect very little change on challenges that are massive for Germany. Maria mentioned greening, digital. but also social protection reform. And of course, for Europe, you see how markets reacted. It means that we won't see a lot of lenience when it comes to fiscal orthodoxy coming from Germany anytime soon.
Is it fair to say then, Ludovic, the burden will be carried by the ECB through this cycle once again? And what does that mean for what you forecast from the European Central Bank and President Lagarde?
I think this is the largest difference between the US and Europe, is that in the US, I think Janet Yellen basically told Jay Powell, let me do it, and he's going to get room to maneuver. In Europe, we know that the discussions about budgeting together are complicated, so the ECB will have to stay in the game and do the heavy lifting for quite some time. What does it mean? It means that we have to find a solution as early as March 2022 to replace PEP and to avoid the risk of having a shortage of financier for the very profligate Italian stimulus, 325 billion. So this risk, because of the key of distribution of what the ECB purchases, not to have enough of public ownership of this Italian debt, and very quickly also to decide on how we go back to the normal when it comes to fiscal rules. And so all of that is a bit, determined by Germany, and whatever happens with Germany over the next few months, there will still be a very strong concern about rules, and especially fiscal rules, and so the ECB will have to continue to be the only game in town.
Ludovic, when it comes to the asset purchase program, it looks like PEP's going to expire when PEP's set to expire, which is going into next year. There's going to be this huge debate in December about what the APP program ultimately becomes at the European Central Bank. How much flexibility do you think that package will need, given everything you've just said?
I think the real issue is, of course, forward guidance more than the plumbing of how much you purchase into the, and if there is tapering or not. That's the type of debate we have here. We have etymology debates rather than real debate about monetary policy. I think the big issue going forward is we need APP to be in the tune of 80 billion purchase per month, which is, between what the PEP gives today and what APP should be if it was left to its own. So it requires a little bit of political momentum for Christine Lagarde and the ECB board to be able to do that. And as I just mentioned, the big question would be whether we go back to APP where Greek debt is not considered collateral, where we have this key of repartition, which is a bit complicated and that may limit what can be done to lower the financial stress on Italy. So we have a few months that are going to be politically charged for the ECB.
Ludovic, to be fair then, just summarize as follows. Do you think it's reasonable to expect at the middle of next year Fed QE to have ended and ECB QE to be running at 80 billion?
I don't know. I think the ECB may taper before the Fed, to be honest, given how the debate is going on in the US right now. So no. I think by the middle of next year, what we will have will be pledging and commitments. But the uncertainty will be still strong on the virus side, but also on the fiscal policy side. In the US, maybe there is a bit more, window of opportunity for the Fed to do something, but we don't expect a hike before 2023. And we certainly don't expect a massive unwinding of the balance sheet too fast. Nobody wants to repeat the Taylor tantrum. And the situation has changed because, as you know, there is a new issue, which is the turbulence on the short end of the yield curve, which I think nobody really talks about. So I think the Fed may do a bit more, but on the ECB front, the French elections are in April. So nothing can really happen before we actually settle what's going to happen on this side of the Rhine.
Ludovic, well said, and great to catch up, sir. It's been too long. Ludovic Subran there of Allianz. Euro dollar, a break of 117, 116.97, down 0.2%. Kit Jukes of SocGen summarising the election over in Germany almost perfectly with a single quote. Europe needs a huge rebalancing between fiscal and monetary policy before the euro has any chance of moving sustainably above 122, and a broad-based coalition is unlikely to deliver it from a market perspective. That is all you need to know. Let's get you some sector price action, a really interesting equity market stateside. With more, here's Dave Wilson.
Thanks, John. You've got a fairly even split among the 11 main industry groups in the S&P 500. Six up, even though the index itself is down. And it's really the tech-driven areas of the market that are leading the retreat here, notably technology itself. Apple down. You had the Nikkei reporting that there are power cuts in China that are affecting the company's suppliers and manufacturers. So that becomes an issue for Apple, especially as they roll out the latest version of the iPhone. And on the flip side, you've got energy stocks higher as we see U.S. crude move above $75 a barrel and European crude at its highest price in about 3 years. And you focus in on the producers. This is a group that really has kind of struggled to get back to where it was before the pandemic began. And, we've seen now 5 straight days of gains, and that is quite a plus for that group.
Dave, thank you. From New York, your equity market a little bit lower this Monday. Your trading diary's next. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
And just like that, nobody's talking about Evergrande. If anyone is interested, there is another interest payment due this Wednesday. We will stay on top of that story, regardless of what this market does. Your equity market is down 1/3%. The Nasdaq's getting it hit on the chin. We are down by more than 1%, with yields breaking out just a little bit higher. That's the price action. Here's the trading diary. What you need to be looking for through the next couple of days. New York Fed President John Williams speaking at noon Eastern. Governor Brainerd later this afternoon. A load of Treasury supply a little bit later today, 1 p.m. Eastern, $61 billion of 5-year notes. Yellen, Powell talking tomorrow. They testify. Plus, we get a ton of data to close out the week. GDP, jobless claims, manufacturing numbers from the ISM. From New York City, this was the countdown to the open. This is Bloomberg.
If you look at China, if you look at U.S. taxes, how much time do you spend figuring out these big overarching themes as opposed to what happens with inflation?
There's an awful lot going on at the moment, as you say, and
clearly some of the big debates at the moment are the slowing global growth picture, which we're seeing everywhere. And we're also seeing that at a time when inflation is rising and is proving pretty sticky. And to your earlier points, Francine, essentially the interplay between those two is critical. So some of those news events this week, whether it's OPEC and what's happening from a supply perspective, is going to be crucial, or indeed, of course, that US CPI print. So we've spent a lot of time thinking about inflation more recently, because clearly that leads into when we feel you may start to see the taper and when you might start to see rates going back up, particularly in the US. I mean, what might be useful just to explain a little bit is the focus that we've seen from everybody on China. You know, clearly China, huge in terms of the global commodity cycle.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease beside disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication?
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He says things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de...
This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.